folks. It is currently 1 o'clock. Yo. We literally just turned halfway at midday. Okay, so today the plan is just to thug through these mentorship videos as quick as possible and making notes. Yo. Hold on. Afternoon. Minimize that. Okay, let's go. Episode 22. Oops.
All right, folks, welcome back. This is the ICT Mentorship free YouTube mentorship. Mentorship for 2022. I hope you're doing well. Hope you had a wonderful opportunity to study and learn this week and keeping up with the lessons. So we are looking at the E-mini S&P daily chart. This is June delivery contract month for 2022. And I'm going to kind of like bring you back up to speed to what we were looking for over the last weeks or month or so. Remember back here, we had that bearish order block. I outlined that as an area to watch that, and we're entering a seasonal tendency, so we're expecting lower prices. We got lower prices. I showed you the relationship between the dollar because it's risk off. So we have all the decline taking place in the equities markets. And I said that we would be likely to draw down into this relative equal low. So I'm going to kind of like do things in the TradingView platform. So that way, some of you folks that are asking questions in the comment section, like how do I do this and where is this on the platform? Admittedly, most everything I know about TradingView, my own students have taught me. So there's going to be a comment posted and pinned by me underneath this video. It'll be TradingView tips. Okay. If you have a tip that you want to share with the viewers that are new to TradingView, please, by all means, just make a post and outline it as best you can. I'm sure they'll be well received. I might even learn something too. All right, so we're looking at how the market did in fact trade down into our relative equal lows. So this was the draw on liquidity. Okay. Now, when I train my students and when new students come to me, the first thing they want to know is how to pick the right order block, because they know it's one of my concepts. They want to know, which is the entry candle. What's the entry point? Where do I get in at? Okay. And that's the easiest thing out of all the learning. Okay.
Thanks.
Once you understand what the market's likely to do, where it's going to draw to, okay, where's it going? Why should it get there? Okay. If you do majority of your studying and watching the tape, okay, reading the tape, which is kind of like what I'm going to outline and showcase in the live streams in May. Just before I get any further in this conversation, the live streams will only be in May. I'm not trying to make an ongoing thing of this. I don't want to promise you, an ongoing thing, but I'm going to showcase some things in live sessions. That way you can see how to train yourself to look for these things. Okay. I will not be giving you trade recommendations. Okay. I will not be entering trades in front of you. I'm going to be outlining basically what you saw me do in this mentorship, outlining where this is going to go, and it went there. I'm going to be doing that with intraday charts. Okay, and I'm going to point out certain areas to study. Watch how price reacts right here, and look for this type of thing to occur here, because I want you to understand what it's doing. Why is it likely to do what I'm going to outline? Okay, the best thing that can happen is for me to get it wrong sometimes. Okay, so that way it'll disarm you. It'll feel like, okay, well, if I don't get it right, ICT himself didn't get it right here or there. Okay, so I'm going to do my best, obviously, to try to educate you and show you what I think is going to happen. But invariably, there's instances it's going to creep in. It's not going to be accurate. Okay, I'm going to read it wrong, and it's fine. Do not take what I'm saying in my commentaries and or my opinions over the chart that's going to be live. Don't take that as trade advice. Do not take a trade. And I'm going to say this every single time I do the live stream. Don't act on it, because you don't know what I'm doing. You don't know what I'm viewing. You don't know what I'm trying to teach you. None of that. Okay, so you want to sit still and just observe and take notes. They will be recorded. They will be on the YouTube channel for those individuals that are not going to be able to be present. When will those live streams take place? There will be a New York session between, I think I'll start around 8 o'clock in the morning. So that way we can get the chart set up. I'll give you my views overnight, what took place and what I think that counter may present, and kind of build the mindset. I will not be talking in the chat room. Okay, the little chat thing on the side. You guys will be saying whatever you want to say. I don't care. I'm not going to be looking at that because it'll be a distraction. The agenda that I have for that particular day, it'll be very distracting for me to read comments and questions. And because I know your question is important to all of you, no matter how simple it may be, I'll feel compelled to want to answer everything that flashes across the screen, and it'll disrupt my concentration. So I won't be looking at the chat. Okay, I'm not ignoring everybody for the sake of being rude. I'm just ignoring everybody so I can stay on task. Okay, so there's that. But we'll begin around 8 o'clock in the morning, and we'll close it, whenever I feel the need to do so. But I'll be willing to go up to 10:30, 11 o'clock. Okay, which is a very long session. I know they may not all go that way. I won't be doing it every day either. So it'll be a handpicked selected day in advance that you'll know about, and I'll post it on the community tab on my YouTube channel. Okay. All right, with all that stuff out of the way, let's get back into the nitty gritty here. So I outlined this area here in this low, and I said this would be the draw on liquidity. So when you're on TradingView, over here, there's a little segment where you can have the choice of certain things. Now you can do this, so it looks like this is your bullseye where you're going to draw to. You're
I
aiming for
never knew
numbers.
that. Wait, what? Wait. magnet. I'll come back to that.
Or you can use the little magnet icon. I teach with that analogy. Like up here, imagine a magnet of some kind down here, and price is going to be drawn down to that level here. So this is where the liquidity was, and they tapped into it today, right? You know about it up here. You know about the order block up here. You know about the seasonal tendency I outlined, and we have this really nice decline here. So I'm going to take you into the marketplace and strip this down a little bit and give you some more details. So we'll go into the hourly chart. And this is why I do PowerPoint slides. It's real easy to get to where I wanted to be. All right, so we had a run here. Yesterday, just kept pumping higher, 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 higher. Just fell short of this high. And then, so we had a decline, and then the normal pause, and they gapped it down, then rallied back up. So between this candle's low and this candle's opening, right in here, that's an imbalance, coupled with an actual gap. So I want you to take a look at that. Okay. Now, we have this candle here, small little piece of that one here, this one, this one, this one, and this one. They go just above that area here. This is permissible price action. In other words, this is something you have to get used to. Okay. Look at the bodies of the candle. See how they're staying inside of that imbalance? It reaches for liquidity and stops on these wicks. But the bulk of the volume is being held inside this imbalance. Notice that? So now we have the market release go to the downside. And then here is 9 o'clock in the morning. I'm going to go into 8:30 actually. Let's go down to a 15-minute chart. So here's 9:30. That opening price here. At 9:30, what's actually happening is the equities are opening up. The stock market starts trading. That's when you hear the bell ding, ding, ding. All of a sudden, everybody's clapping their hands on TV, whatever. That's what's occurring here. It's opening. So it's running a short-term high right here, and then breaks lower. Creates an imbalance here. So on the 15-minute time frame, what do we see? Did it take a high out? Yes. Did it break below low? Yes. Was it displacement? Yes, it was energetic. Did we trade back up into it here? Yes. So in here, you could be a seller and get in sync with the run to try to get positioned for, if you are a swing trader or short-term trader, this could be your entry and aim for that old relative equal low, which is that blue line here. Remember the 2 equal lows on the daily chart? I drew a line on. This is what this is here. Okay, and it ran down into it today. At 8:30, right there, we're using the opening price. Did price trade above it? Yes, it's in premium. It's above an old high. That makes it a premium too. I believe it was the only, and I apologize, I don't recall, and I didn't make a note of your name, so please don't get offended. I know I saw it where it was saying something to the effect that you don't understand how it could be in a premium because it's above an old high. Anytime the market trades above an old high, that is a short-term premium because it's going into liquidity. Anytime the market trades below an old low, that's a discount. Okay. Now, just like the purposes of what people use overbought, oversold indicators, things can be overbought and still go higher. Things can be oversold or in a discount and keep going lower. Okay. So yeah, that's why I'm suggesting that when people are studying price, they can't just assume that an indicator is overbought, so therefore it's a good sell or a shorting opportunity. It's not always. But if you understand the narrative within market structure is not the answer. It helps you frame an idea, but the idea must be in alignment with the present narrative. Narrative is why should the market go where you think it's going to go on that particular day, based on the climate, the economic calendar events, and the volatility that's being offered for that particular trading session or day. So these are all things that you're going to need to study, and I teach on this YouTube channel. And I'll teach a little bit more when we're doing the live sessions because it'll be more practical then. That way you're over my shoulder, you're looking at it just like I'm looking at it, and I'll give you my internal dialogue and kind of like what I'm thinking that is the most salient at the moment. So that way your attention is on the right things at the right time. But power 3, which is the open, rally up or manipulation, create a high, and then the movement lower, and then distribute their shorts below an area where there would be stops. So smart money would be selling short the buy stops here, writing this out, and offloading their shorts to sell stops below those relative equal lows. Remember, when we see these relative equal lows on the daily chart, traders are going to look at that as a breakout. There's lots of traders out there that have long-term trend following systems and models, and if it breaks below those areas, they want to be short. So that's going to flood the market with what? Market orders to sell at the market. Well, that's a perfect counterpart to smart money being short up here because they want to buy it at a lower price. And while up here, they're aiming down here. Is it hard to believe that when we were already outlining that last week and the week before? No. We have visibility. We have the ability to forecast certain things that should repeat. If the algorithm is in fact in control, and we understand what the algorithm is doing, and I'm suggesting that my experience should indicate that we have that, does it deliver? Here it is. Okay, so you're taking the logic of certain principles and concepts and blending them with market structure. We're looking for lower prices, it should reach for a specific low, but also how does the present narrative allow for engagement with the daily range, or power 3? Everything I've taught you. So it's the open rally. Smart money enters near the high today above the opening, and you get out down here at an important low, and market closes near the low of the day. Let's go into a 5-minute chart. 1, 2, relative equal highs. You see that? Now, if you're looking at the lower time frame charts, let me get this. It's no longer useful. If you're looking at that like that, here's the opening price. You know there's what resting above that. Buy side. So buy stops or buy side liquidity is resting here. So it can run up, and just to the left of that, also, you see these highs here? They're real close to one another too. So for good measure, they might want to come up here and clean that down. This is a little too much. I think it's too rich for the expectation to get to that high. But in here is reasonable, but here at least. Okay. Mark punches up through. Yes, it does take those out. Then it breaks down, comes one more time back above the opening price, and then gives up the ghost and aggressively runs for the sell side below here. Now, for some of you, that would be enough. Getting short up here, buying back below the lows, and being done and walking away. There's nothing wrong with that if that's your model. But we're going to take a closer look inside of this area here and see what we see. let's drop down into, I'm just going to go right to the 1 minute chart just to save time. All right, so we have in this area, the market ran above those relative equal highs. Here they are here. The market runs up, then it breaks down right here. See that right there? That's a swing low. Breaks below it. Was it displacement? Yes. Does it mark come back up into this little area here? Yes. Is it above the opening price? Yes. Is that enough? Sure it is. You can be short there. You have to weather this one more run up into your entry, and you may have a little bit of drawdown. But your stop loss, if you're entering this fair value gap, your stop has to be above the very minimum. The candle that creates the fair value gap, that's here. So your stop's going to be above that. For good measure, conservative, up here. Oh, but ICT, that's a lot. That's a big stop. Well, look how volatile it is. You want to be knocked out of the trade prematurely, or are you just concerned about making the maximum amount of money on your trade, dismissing the level of risk? That's what gamblers do. I'm not trying to teach gambling. So when you practice on your demo account, keep that in mind. That you're not trying to overextend yourself. The sell side below these lows in here, after it hits the fair value gap here, and one more time into it, above the opening price, it breaks lower and aggressively runs below here. So not a bad little run there. Let's go back up to a 5 minute chart. Okay, and we're going to go look at the afternoon session. Here is 1:35, and I remember I stated at around 1:30. That's when I like to go back in. Now I've taken trades earlier than that, but I'd like to see 1:30. After 1:30, the lunch hour has been smoothed out, and then there's usually some kind of a retracement higher when it's bearish or retracement lower when it's bullish. And you're seeing that here. The imbalance, relative equal highs. It runs up into that right there. That's an area you can get short on. Market delivers a run lower. Here's another little fair value gap in there. It runs up into that. That's a short, aiming for what? That line here. That's that relative equal low on the daily chart. So today, huge, huge opportunity day. Lots of points that could have been made available. But I did something this morning showing everyone kind of like what reading the tape examples will be like when I'm doing the live session. I did some executions just to prove visibility, to prove I was expecting a certain run, and I believe I was in NASDAQ. Yeah, I was in the NASDAQ. So let's go over to NASDAQ. Okay, that's in here. So we're going to zoom in here on this bit of business. All right, and here is what I had in mind when I was looking at the chart. Woke up this morning. My wife is out of town with my daughter, so I woke up and just because, creature habit, your spouse ain't next to you, so I had insomnia. So I sat up and I was looking at the chart and said, well, you know what? I see. Well, let me ask you what you see before I do it, okay? What gave me the backdrop for all this in here, which I'll explain in detail in a moment, but what gave me the realization that this is likely to turn here and go lower? Study the entire fractal that's being shown, okay? Pause the video. So you just refuse. I'm never going to do what I see. Stop asking me to do it. All right, so we had this high here. We ran above it, and then we had the market shift. So buy stops taken, breakout orders taken in on the market long, and then relative equal lows broken. So we have a shift in market structure on a 5 minute chart. In a time when it's bearish, we're looking for those relative equal lows to be tagged on the S&P. And this is not the S&P, I understand that, but the expectation is we want to see these two indices go down on the daily chart. So heaviness should be the protocol going into our trading day. In here, we have what? Displacement below these lows. So there's a lot of energy there. So right above that, what do we have? Fair value gap. Well, they have one right here too. Right. What did I teach you? This is where you do your entry. But ICT, you didn't enter here. Right. I wasn't looking at the chart yet. I'll get to that. Easy my mind. Give me my mind. This fair value gap here, we expect that to stab up into it. So our stop has to at least be in a position where it can weather that. So what does that mean? That means that you have to either have deep pockets and allow for your stop loss to be inside this here, or you use the micros, which is fine. I don't do a micro, man. I'm going to be in here $20 per point. Okay. But you have to have an account that will allow for that. If you don't have that, then trade a micro. But I don't want to do that. Okay. Gamble. But not because I taught you to do that. So here is the order flow inside of that fair value gap here. Again, a little bit of extra runs above into that fair value gap there. I'll put another rectangle so you can get a visual representation of what I mean. I mean, you can clearly see, obviously, but I want you just to see it by contrast. So this is the rules. This is why I've been teaching you. Okay. If there is only one fair value gap, then you just put your entry there and you don't expect it to go up into any deeper retracement. But because it has another one here, you expect it to stab up into that. Now, I know some of you in here want to be an ICT junior and you want to be in there on the highest candle when you're selling, you want to be on the lowest candle when you're buying, and I understand. But this isn't always going to happen. So if you're really only trying to aim for that, you're going to miss moves. And if it moves like it did today, that's a heartbreaker because it moved a lot. And if you weren't positioned in it and you spent the rest of the day kicking yourself about being greedy about trying to get that instead of where I've already taught you, you'll probably miss the other moves that take place later in the afternoon and you get nothing for the day. All right, so anyway, so we have a shift in market structure. We move up into fair value gap here, and we have a break lower, fair value gap here, relative equal lows. Now look real close, folks, okay? Relative equal lows, a high being taken here, we break down, these two candles move right below here. That's the same thing as these two candles here being broken with this move here. It's a fractal. This whole move here is the same thing here, just smaller. And it creates the same thing. The fair value gap here, the market trades up into it, the body's kind of respecting that low area. Moves a little bit above it, that's fine, but then breaks aggressively lower. Does it take out the low yet? No. Retraces up in. Now I have two, okay? Not one, I have two narratives in play. This one here, where we have a shift in market structure there. So this is a long-term high. Here, we have another break lower, win imbalance, so it's intermediate term high. This is a bigger one than that one, right? So this is a long-term high, intermediate term high. By definition, they're both intermediate term highs because they have imbalances. But this one's lower than this one. And this over here is lower than that one. So this is a turning point, making this by the hierarchy of swing points and market structure. This is a long-term high. Intermediate term, intermediate term because of the imbalance, but how they nest together for market structure, long term, intermediate term. Now, when this is retracing up, this is going to be a short term high inside of a market structure that is really predisposed to go lower because we have long term and intermediate term above me. This should respect the underlying order flow and go lower. And I'm looking for that lower price that's below here. There's sell stops resting below that. So as it retraces back up into this up close candle, what is this up close candle? It's a bearish order block. That's not what you can teach us, Mike, on this model. Right. I didn't say that's what this was. I'm telling you how to read the tape. Okay. But I do teach order blocks on the channel. So we're going to go into this right here. So inside this shaded area, this is what I'm going to be executing in. Not with that color in. Okay, that's good enough. May not be your choice, but it's mine now. All right, so we're going to drop into a 1 minute chart. Every time I do this, I always imagine somebody has a little bit better understanding how to work with the TradingView platform. They probably have a whole lot easier, quicker way of getting to where I'm trying to get to. Sorry. All right, so we're inside of that blue shaded area on the 5 minute chart. I'm also inside of this green candle here. That's a bullish order block. So what I'm doing is now I'm going to calibrate, which just simply means I'm going to go down and with a top-down analysis approach, refine that order block that was on 5 minute down to this one. So the market retrades back up into here, into that order block. And I'm trying to aim, once it hits the midpoint of it, I want to get in around that time. Okay, so I'm entering there on that candle, and then I'm holding in all this, and it drops back down. Now, some of you might look at this and say, oh, but this is that order block, fair value gap here, and what happens if it rallies? Well, it does a little bit, but what's it subordinate to? All the things I outlined over here, and on the 5 minute chart over here with a higher swing high. So the market structure is bearish. I'm not looking at this setup. This is why I'm telling you, I tell this all the time, okay, is me teaching my order block theory, me teaching my fair value gap concept, is it going to become ineffective? No. Because number one, it takes a lot of discipline. You have to be absolutely organized. You have to know what you're doing. And that's why a lot of people just teach it from hindsight because they can't really do it. So you can sound real smart, you can sound real educated and institutional, quote unquote, but if they can't do it, it's useless. So if I'm showing you these things, and I'm telling you also, look around, majority of the people that parrot what I teach, that means they're mimicking by saying what it is I already said, like an echo, but they're really not doing it. They're not doing it like I'm able to do with it. That should be your comfort. That people, by far and large, humans are lazy creatures. Okay, they're lazy. And they're not going to be predominantly rule-based, disciplined, responsible. They're going to be lazy, and they're not going to do what's supposed to be done. So it won't change anything. Okay? It won't make these things inferior. It won't change their superiority. It will not make them ineffective. They will remain constant. Now, the algorithm. I don't care how many people learn from this YouTube channel. Okay? I don't care how many people rip me off and try to rebrand and change the name of everything I've taught. All of that saturation will not change because what I just said. The algorithm is going to change. There's new suckers coming in all the time. PT Barnum said it really, really accurately. There's a sucker born every second. So you're never going to run out of liquidity. Somebody's born. Somebody gets old enough to start speculating and trading. Boom. They're in the marketplace. And that liquidity will just add to the liquidity that will be on the other side of your trade. So there's no reason for you to be worrying about whether or not this is going to be in effect. I've been teaching this for a long time, okay, privately. And listen, if I honestly believed in my heart of hearts that this would fail and stop working if I taught it, I would not teach it. I wouldn't. I would have never even mentioned it. And I'm being honest. So take heart. There's no reason for you to be upset about or worried or concerned. It will remain. As long as the markets are trading, these elements will be in these markets. There it is. All right, so the market rallies up. It stabs above the order block here, but it's just a wick. See that? The bulk of the volume in the bodies of the candles are inside that order block. Then the market does what? It breaks and shows displacement here. Remember what I said about this pattern here? Relative equal lows, it breaks down and it goes back to a fair value gap. Here it is again, relative equal lows, displacement, fair value gap. What does it do? Go right back up into what? A fair value gap. And look closely. The bottom of the bearish order block. See that? Bam, hits it. You watch me looking at the chart. It's there, and I'm entering on that candle. I'm not entering it because I wasn't really looking at the screen at the second when I was holding the phone this morning, but I wasn't looking at it here. This is a 1 minute chart. I was doing something else. Then I looked back at the screen. I seen it went up there and hit it. And after it failed it, then I put my market order to go in and sell 2. I sold 3 contracts here. I sold 2 contracts here, and then I entered again here. After it did what? Retraded back up into this bearish order block here. So it moved down, came back up in, and I'm selling short here, there. Okay? What's the low on that candle? Right here. Fair value gap, that's here. So your stop's got to be above that. Here, and an important low. And market closes near the low of the day. Let's go into a 5 minute chart. 1, 2, relative equal highs. You see that? Now, if you're looking at the lower time frame charts, let me get this off. It's no longer useful. If you're looking at that like that, here's the opening price. You know there's what resting above that buy side. So buy stops or buy side liquidity is resting here. So it can run up, and just to the left of that, also, you see these highs here? They're real close to one another too. So for good measure, they might want to come up here and clean that down. This is a little too much. I think it's too rich for the expectation to get to that high. But in here is reasonable, but here at least. Okay, market punches up through. Yes, it does take those out.
I was just listening but not making notes, so I'm going to go back and take notes of the things I think are important to know. So the first thing I want to talk about here, or at least make a note of, is buy side liquidity. I think it's also good to use these key terminologies so that when I'm trading and I want to see things on bias, I can then just filter my whole document through that and then look for whatever is relevant to that keyword. So that's why I'm like in the keywords a bit. With the buy side liquidity in this instance, we starting with time. Yeah. Starting with time, we can see this. It's around 8:30 a.m. And we are looking for relative equal highs. Context. We are bearish. We have a bearish bias. That's funny. I didn't realize it was still there. We have a bearish bias, and actually, it's just put full stop there.
Then it breaks down, comes one more time back above the opening price, and then gives up the ghost and aggressively runs for the sell cycle up here. Now, for some of you, that would be enough. Getting short up here, buying back below the lows, and being done and walking away. There's nothing wrong with that if that's your model. But we're going to take a closer look inside of this area here and see what we see. All right, let's drop down into, I'm just going to go right to the 1 minute chart just to save time.
That's the main point I wanted to make. How the level we looked for wasn't these highs up here, was these ones and these ones. So 1 and 2, because they were close to price. It's possible it goes up here, but we're not aiming for that. We're low hanging fruit. And that low hanging fruit is a key terminology because it sounds boring, it sounds unattractive, but the point of it is to get the system ingrained into your way of thinking, so that when you then want to transition from low hanging to high hanging, you then have the foundation. Because when you aim for a high hanging fruit without skills, you may fall due to things outside of your skill set. Imagine your skill set being a ladder, right? When you put a ladder up and you're looking for fruit, you don't even need a ladder sometimes. When the fruit is very low hanging, you can just reach your hand up and achieve it. It's close to you. It's easy to get to. It's not difficult, right? But when you now want to start reaching the top of the tree, and I don't know if you guys have seen a coconut tree, but those coconuts be high. Trying to climb that tree or trying to get a ladder, there's more risks accompanying that feat. It's possible, and there are very skilled people that can do it consistently, right? I mean, we see coconuts in the supermarket, but the idea is that you don't want to start, especially when you're new, you don't want to just start going straight for the top of the tree. So you want to work your way up and start by getting what you can reach. And sometimes the low-hanging fruit is respectable because we're all different heights. We all have different understanding. We all have different experience. We're all starting differently. So someone's low-hanging fruit could be the most simplest portion of the model, and they look for one specific type of thing. And then they only take the worst case scenario, as in, like, if they want to enter a buy, they enter the upper bound of a low fair value gap, targeting the most closest liquidity, buy side liquidity. So it's relative, but for me, I would say mine is kind of intermediate or / medium level. Like, I'm not looking for the lowest hanging fruit of possible, but I'm not looking for the top of the tree either. How did he do that?
All right.
Oh, I never, bro. I might need to hold up. How to bring back that? I'm looking for the thing on the side that I got rid of. I forgot how I got rid of it. So it is a setting. It doesn't exist. Horizontal lines, top left corner. Yeah. I didn't know that, dude. And then the magnet, where is it? Yeah, sure, go first. Use them out.
For the expectation to get to that high, and you get out down here at an important low.
Let's see it.
That means that you have to either have deep pockets and allow for your stop loss to be inside this here, or you use runs up, then it breaks down right here. See that right there? That's a swing low. Breaks below it. Was it displacement? Yes. Does it mark come back up into this little area here? Yes. Is it above the opening price? Yes. Is that enough? Sure it is. You can be short there. You have to weather this one more run up into your entry, and you have a little bit of drawdown. But your stop loss, if you're entering this fair value gap, your stop has to be above the very minimum. The candle that creates the fair value gap, that's here. So your stop's got to be above that. For good measure, conservative, up here. Oh, ICT, that's a lot. That's a big stop. Well, and you're seeing that here. The imbalance, relative equal highs. It runs up into that right there. That's an area you can get short on. Market delivers a run lower. Here's another little fair value gap in there. It runs up into that. That's a short. Aiming for what? That line here. That's that relative equal low on the daily chart. So today, all right, let's drop down into, I'm just going to go right to the 1 minute chart just to save time. All right, so we have in this area, the market ran above those relative equal highs. Here they are here. The market runs up, then it breaks down right here. See that right there? That's a swing low. Breaks below it. Was it displacement? Yes. Does it mark come back up into this little area here? Yes. Is it above
There's a displacement.
the opening price? Yes. Is that enough? Sure it is. You can be short there. You have to weather this one more run up into your entry, and you have a little bit of drawdown. But your stop loss, if you're entering this fair value gap, your stop has to be above the very minimum. The candle that creates the
It's talking about
fair value
that.
gap, that's here. So your stop's got to be above that. For good measure, conservative, up here. Oh, ICT, that's a lot. That's a big stop. Well, look how volatile it is. You want to be knocked out of the trade prematurely, or are you just concerned about making the maximum amount of money on your trade?
I just did realize there's two ways to do screenshots. You can do voice typing. Oh my gosh.
Dismissing the level of risk. That's what gamblers do. I'm not trying to teach gambling. So when you practice on your demo account, keep that in mind. That way you're not trying to overextend yourself. The sell cycle below these lows in here, after it hits the fair value gap here, and one more time into it, above the opening price, it breaks lower and aggressively runs below here. So not a bad little run there. Let's go back up to a 5-minute chart. Okay, and we're gonna go look at the afternoon session. Here is 135, and I remember I stated at around 130. And here is what I had in mind when I was looking at the chart. You're gonna miss moves, and if it moves like it did today, gamble, but not because I thought you did. But as you see, you didn't enter here, right? I wasn't looking at the chart yet. I'll get to that. Easy my mind. This fair value gap here, we expect that to stab up into it. So our stop has to at least be in a position where it can weather that. So what does that mean? That means that you have to either have deep pockets and allow for your stop loss to be inside this here, or you use the micros, which is fine. I don't do a micro, man. I'm gonna be in here $20 per point. Okay, but you have to have an account that will allow for that. If you don't have that, then trade micro. But I don't want to do that. Okay, gamble, but not because I taught you to do that. So here is the order flow inside of that fair value gap here. Again, a little bit of extra runs above into that fair value gap there. I'll put another rectangle so you can get a visual representation of what I mean. I mean, you can clearly see it, obviously, but I want you just to see it by contrast. So these are the rules. This is why I've been teaching you. Okay. If there is only one fair value gap, then you just put your entry there and you don't expect it to go up into any deeper retracement. But because it has another one here, expect it to stab up into that. Now, I know some of you in here want to be an ICT junior and you want to be in there on the highest candle when you're selling, you want to be on the lowest candle when you're buying, and I understand. But this isn't always going to happen. So if you're really only trying to aim for that, you're going to miss moves. And if it moves like it did today, that's a heartbreaker because it moved a lot. And if you weren't positioned in it and you spent the rest of the day kicking yourself about being greedy, about trying to get back instead of where I've already
Just realized I was muted. Excuse me. So yeah, I want to make a note of this. We made a note of it before, which is the fair value gap, where we have more than one. So you can see here it's stacked, right? It's one big move, but there's one here, one here, one here. There's three, right? And even one here technically. And our purpose, what we're trying to do, is simply account for it. And we may not always predict which one it will respect, but we utilize this lower one over here, expecting price to come up here. So for example, if I was to enter here, I would set my stop loss normally above the first candlestick contributing to the fair value gap, which would be this, which in this instance I would have been fine anyway. But if there's one up here, for example, I should expect that price could even go up here, right? It may not, but I expect it. And what's that? How we do account for that? We said it here, right? Where we account for it by our stop loss. So our stop loss is going to be like, you know what? We're going to enter in early. We're going to target this low down here. Although we want price to not go up here, we're going to expect it to go up here by putting a stop loss there. Now, if I ever reduce my stop loss, I need to accept that there's potential for price to go my direction and stop me out in doing so.
taught you, you'll probably miss the other moves that take place later in the afternoon, and you get nothing for the day. All right, so anyway, so we have a shift in market structure, we move up into fair value gap here, and we have a break lower, fair value gap here, relatively equal lows. Now look real close, folks, okay? Relatively equal lows, a high being taken here, we break down, these two candles move, break below here. That's the same thing as these two candles here being broken with this move here. It's a fractal. This whole move here is the same thing here, just smaller, and it creates the same thing. The fair value gap here, market trades up into it, the body's kind of respecting that little area, moves a little tape, okay? But I do teach order blocks on the channel. So we're gonna go into this right here. So inside this shaded area, this is what I'm gonna be executing in. Not that color in. Okay, that's good enough. May not be your choice, but it's mine now. All right, so we're gonna drop into a 1 minute chart. Every time I do this, I always imagine somebody has a little bit better understanding how to work with the TradingView platform. They probably have a whole lot easier, quicker way of getting to where I'm trying to get to.
Facts.
All right, so
Need to learn that.
we're inside of that blue shaded area on the 5 minute chart. I'm also inside of this green candle here. That's a bullish order block. So what I'm doing is now I'm going to calibrate, which just simply means I'm going to go down and with a top-down analysis approach, refine that order block that was on 5 minute down to this one. So the market retrades back up into here, into that order block. And I'm trying to aim, once it hits the midpoint of it, I want to get in around that time. Okay, so I'm entering there on that candle, and then I'm holding in all this, and it drops back down. Now, some of you might look at this and say, oh, this is that order block, fair value gap here, and what happens if it rallies? Well, it does a little bit, but what's it subordinate to? All the things I outlined over here, and on the 5 minute chart over here with higher swing high. So the market structure is bearish. I'm not looking at this setup. This is why I'm telling you, I said this all the time, okay, is me teaching my order block theory, me teaching my fair value gap concept, is it going to become ineffective? No. Because number one, it takes a lot of discipline. You have to be absolutely organized. You have to know what you're doing. And that's why a lot of people just teach it from hindsight, because they can't really do it. So you can sound real smart, you can sound real educated and institutional, quote unquote.
I'll make a quick note of that. I'll let him talk as well.
But if you can't do it, it's useless. So if I'm showing you these things, and I'm telling you also to look around, majority of the people that parrot what I teach, that means they're mimicking by saying what it is I already said like an echo, but they're really not doing it. They're not doing it like I'm able to do with it. That should be your comfort. That people, by far and large, humans are lazy creatures. Okay, they're lazy. And they're not going to be predominantly rule-based, disciplined, responsible. They're going to be lazy, and they're not going to do what's supposed to be done. So it won't change anything. Okay? It won't make these things inferior. It won't change their superiority. It will not make them ineffective. They will remain constant. Now, the algorithm. I don't care how many people learn from this YouTube channel. Okay? I don't care how many people rip me off and try to rebrand and change the name of everything I've taught. All of that saturation will not change because what I just said. The algorithm is going to change. There's new suckers coming in all the time. PT Barnum said it really, really accurately. There's a sucker born every second. So you're never going to run out of liquidity. Somebody's born, somebody gets old enough to start speculating trading, boom, they're in the marketplace. And that liquidity will just add to the liquidity that will be on the other side of your trade. So there's no reason for you to be worrying about whether or not this is going to be in effect. I've been teaching this for a long time, okay, privately. And listen, if I honestly believed in my heart of hearts that this would fail and stop working if I taught it, I would not teach it. I wouldn't. I would have never even mentioned it. And I'm being honest. So take heart. There's no reason for you to be upset about or worried or concerned. It will remain. As long as the markets are trading, these elements will be in these markets.
Oh, this is 4 a.m.
All right, so the market rallies up. It stabs above the order block here, but it's just a wick. See that? The bulk of the volume and the bodies of the candles are inside that order block.
I'll go back some context. Let me see. Let me first draw this is 3241. See this.
Inside the shaded area, this is what I'm going to be executing in. Not that color in. Okay, that's good enough. May not be your choice, but it's mine now. All right, so we're going to drop. This is a bigger one than that one, right? So this is a long-term high, intermediate term high. By definition, they're both intermediate term highs because they have imbalances. But this one's lower than this one. And this over here is lower than that one. So this is a turning point, making this by the hierarchy of swing points and market structure. This is a long-term high. Intermediate term because of the imbalance. But how they nest together for market structure, long-term, intermediate term. Now, when this is retracing up, this is going to be a short-term high inside of a market structure that is really predisposed to go lower because we have long-term and intermediate term above me. This should respect the underlying order flow and go lower. And I'm looking for that lower price that's below here. There's sell spots resting below that. So as it retraces back up into this up close candle, what is this up close candle?
Order block.
That's not what you're teaching us, Michael. Right. I didn't say that's what this was. I'm telling you how to read the tape, okay? But I do teach order blocks on the channel. So we're going to go into this right here. So inside this shaded area, this is what I'm going to be executing in. Not that color in. Okay, that's good enough. May not be your choice, but it's mine now. All right, so we're going to drop into a 1 minute chart. Every time I do this, I always imagine somebody has a little bit better understanding how to work with the TradingView platform. They probably have a whole lot easier, quicker way of getting to where I'm trying to get to. Sorry. All right, so we're inside of that blue shaded area on the 5 minute chart. I'm also inside of this green candle here. That's a bullish order block. So what I'm doing is now I'm going to calibrate, which just simply means I'm going to go down and with a top-down analysis approach, refine that order block that was on 5 minute down to this one. So the market retrades back up into here, into that order block. And I'm trying to aim, once it hits the midpoint of it, I want to get in around that time. Okay, so I'm entering there on that candle, and then I'm holding in all this, and it drops back down. Now, some of you might look at this and say, oh, but this is that order block, fair value gap here, and what happens if it rallies? Well, it does a little bit, but what's it subordinate to? All the things I outlined over here, and on the 5 minute chart over here with higher swing high. So the market structure is bearish. I'm not looking at this setup. This is why I'm telling you, I tell this all the time, okay, is me teaching my order block theory, me teaching my fair value gap concept, is it going to become ineffective? No. Because number one, it takes a lot of discipline. You have to be really, really accurately. There's a sucker born every second. So you're never going to run out of liquidity. Somebody's born, somebody gets old enough to start speculating and trading, boom, they're in the marketplace. And that liquidity will just add to the liquidity that will be on the other side of your trade. So there's no reason for you to be worrying about whether or not this is going to be in effect. I've been teaching this for a long time, okay, privately. And listen, if I honestly believed in my heart of hearts that this would fail and stop working if I taught it, I would not teach it. I wouldn't. I would have never even mentioned it. And I'm being honest. So take heart. There's no reason for you to be upset about or worried or concerned. It will remain. As long as the markets are trading, these elements will be in these markets. There it is. All right, so the market rallies up. It stabs above the order block here, but it's just a wick. See that? The bulk of the volume in the bodies of the candles are inside that order block. Then the market does what? It breaks and shows displacement here. Remember what I said about this pattern here? Relative equal lows, it breaks down and it goes back to a fair value gap. Here it is again, relative equal lows, displacement, fair value gap. What does it do? Go right back up into what? A fair value gap. And look closely. The bottom of the bearish order block. See that? Bam, hits it. You watch me looking at the chart. It's there, and I'm entering on that candle. I'm not entering it because I wasn't really looking at the screen for a second when I was holding the phone this morning, but I wasn't looking at it here. This is a moment in the chart. I was doing something else. No, back to the screen. I seen it, went out there and hit it. And after it filled it, then I put my market order to go in and sell 2. I sold 3 contracts here. I sold 2 contracts here, and then I entered again here. After it did what? Retraded back up into this bearish order block here. So it moved down, came back up in, and I'm selling short here, there. Okay? What's the low on that candle? Right here. Look at this figure right there. So 13,334 and 3/4. And my entry as it ran up into it on this candle, the entry was 13,335. So it was only a quarter of a point above into that candle. That was my entry. It had a little bit of heat here. So on that entry, it was 1 contract here. So notice what I'm doing. I'm entering at the largest portion of the setup, or the framework for the trade. I'm going in with my maximum position size, first 3 contracts there. Then selling 2 here. And then I'm adding the last one here. At logical, precise areas. It's not randomness, it's not willy-nilly, it's not flipping a coin, it's not guessing. There's logic here, okay? So when the market has this heat on it here, the highest value that candle goes to is 13,339.5. So 4.5 handles. That's the heat I took on that there, but only on 1 contract, okay? Because I have 2 contracts I'm short from back here, and I have 3 contracts short from over here. So I have all this built in equity with 5 contracts. So the 1 contract here that only has 4.5 points of heat on it or drawdown, it's insignificant. I don't even worry about it. I'm not thinking about it. And that's why when I pyramid and I build in large positions, I'm starting with my biggest position first, and then I'm going smaller and smaller until I can't do any smaller. I don't ever do the final 1 contract and do 1 more and 1 more and 1 more. I don't do that. I don't need to do that. So once I have that position established, then I submitted to the idea of it going down to that level that I drew out on the, I forgot what time frame it was now, but we'll draw back out in a second. But here is the exit here. I'll put all 6 back at 13,285 even. I want to be just above the level because it might do these little shallow runs and it might not give me my fill. It does a little bit of that in here, and then finally digs a little bit deeper. I just would have had to wait a little bit longer to get the fill, but it happened right there. And I put something that when it happened, boom, and showed you a little screenshot. There it is. Now, that's reading the tape. That is reading the market. That's getting familiar with order flow. And for those of you that are students of mine for a longer time than just recently, you recognize this as a market maker somehow. So I was selling in an area where distribution would take place. So all this stuff is there. It's logic. I'm going to say this point because I know there's people out there going through my trade statements and you're looking for precision. There's a lot of things I'm doing in that in those statements that have nothing to do with trying to be precise. You guys want to see an account go up. I provided that. I also provided a way for my students that were asking me that I'm obligated to show them where if they went into a period drawdown, how they fix it. And also had lots of questions like, and I did it this morning with, let me see where was the entry at. The second one I did 2 contracts right there. Okay. When I did that one, it was after I did the, or what did I go back in? Well, there, the one where I had the fair value gap, so I didn't see it when it was forming and filling it in. After it filled it, it was still close to it. So it's a close proximity entry. A lot of the trades in that TD Ameritrade account, I'm using close proximity entries. And I'm also using things that you don't know about. Okay. I'm also proving to some of my students where if they got into a marketplace and they take a trade and they don't get stopped out, but they sit through drawdown, how to weather that. You are not privy to the conversations I'm having with these students. So don't assume that you're looking at their statements thinking, oh, this is all he's got. That's not all I got. I'm actually doing something else. There's somebody out there talking, saying they can do things and I can't trade, and I'm baiting them. I want them to step out, but they won't. Okay. I want them to think that that's all I could do. And even then they wouldn't budge because he knows I can do better than them. This is not even the best. There's other things you can do with my concepts right from this YouTube channel that's more precise than this. I know it sounds hard to believe, but it is what it is. I don't want those statements that I was sharing because like everything else of mine, people take my stuff, remove my name, rebrand it, and they say, this is my stuff, this is my creation, this is whatever, and they sell and they scam. If I give statements that have real-time sales with live account and I'm producing like you see here, is it hard to imagine someone taking that and showing it to people and saying that's their results and scamming them? Think about it, folks. Everything I do, there's a rhyme and reason for it. I'm not reacting to someone else's negative discord. So today, this is the last of the business here, and we're done. So I did all this overnight going into a pre-New York session. Then we had all this back and forth. They pumped it up over the overnight high here, and then we go back into that discussion we had earlier. So they ran high here with this run up, and at 9:30, that's when we expect that volatility to come in, and it's right here. Okay, so a little bit of whipsaw in here, boom, rallies. In my live trading account, I took a long in here, and I got out at, I think it was 13,409. I wanted 13,425, but I was a little apprehensive thinking they may not stab through it. They were getting real close to it, and it's hung around. And I got out just a little bit prematurely, and that was it. And I didn't take anything until later on the afternoon. Took a small little scalp in here, maybe about $740, I think it was. And that was it. My attention diverted because I'm Mr. Mom right now. My wife's not with me, and the 2 children I have that live with us still. I'm in charge of homeschooling them still and running this business, and I have 2 boxers that are highly demanding of my time. And I know some of you are saying, get to the point, get to the point. The point is I'm a real person, okay? So I'm not able to be in every single move because I'm doing other things, and I have a life. I know it seems like I probably don't, but I really do. And as introverted as it is, and as simple as it is, I love my life, and I like doing the things I like doing in my life. But the markets are not everything in my life. But hopefully, got something out of this, and you can see how we did again. Draw lower on NASDAQ, and I think that will be it for this one. Let me go back to evening S&P. You can see the relationship there. So both of them moving in concert, both of them moving in tandem, but look closer. Okay, this is why I went back to evening S&P. Why did you do that, ICT? Do you see that? Look at the high here at 2 o'clock in the morning, 2:30 in the morning today, Friday, April 29, 2022. The rally here after 8:30, it creates the high, but it's lower than the high it took 2:30 overnight. Now go back to the NASDAQ. See that? 235, and we have a higher run on NASDAQ. So this is what I teach as SMT, okay? It's showing a willingness to crack the correlation between like markets. These are closely correlated assets. The S&P 500 stocks composite and NASDAQ 100 stocks composite. They generally move together in tandem, not all the time. So if we're bearish and we're expecting lower prices, and we see this, but the S&P doesn't do it, that's showing you that this is a stop run, and it shows that S&P is really weak. So this gives you confirmation without using an indicator, okay, without having anything on the chart. It shows you, let me just do it here. When you have the NASDAQ like this, you can do a compare and contrast by hitting this little tab here. And we're going to add this evening S&P, new pane. So it plots it below, and then with your comparing highs, you want to go over here, go to the little gear, price source, you want to change that to high. And you can see high, the high, high, the high. Higher here, lower there. So it looks like a divergence, you see that? With an indicator, but it's not an indicator, it's price. So I use intermarket relationships and correlation used properly. There's a lot of people that talk about correlation, they have no idea what they're talking about. But if you look at the idea of this relationship here, it gives you like an X-ray view of real accumulation and distribution. This is distribution because it doesn't see the same rally higher that the NASDAQ did. Okay. There was two other things on my agenda here. I mentioned to one of the young ladies I would show the fib. This is nothing else, so you guys are all welcome to turn the video off because this is not going to be teaching really anything. It's for those individuals that just want to calibrate their Fibonacci and also some of the points I add to the chart. And I'll show you what that means here. Price note. And someone asking how do I put those little annotations on. Just anchor to the high you want, drag it over. If you hold down the shift button, it'll make it.
It's over here, just below the. I don't have it. I don't see it.
Price note. And someone asking how do I put.
Where did you get that from?
Points I add to the chart. And I'll show you what that means here. Price note. And someone asking how do I put those little annotations.
Pretty cool. I've never actually used any of these. I don't know why I haven't. It's very simple. Okay, it comes with an arrow. Into that. Can you actually? Well, you could put my face in this. Yo. Kind of cool though. Emoji. Okay. Wait, how does this appear? Hold on. Let's see how it appears. Okay. Can embed that. What else? Okay. How did he do that? It was an icon. Let's see. I understand it now.
Annotations on. Just anchor to the high you want, drag it over. If you hold down the shift button, it'll make it level. You can also do that with your trend lines. So if you want to add here, you start dragging it. If you put the shift button, it'll automatically toggle it and keep it straight. And so many of my students were so helpful because it used to drive me crazy. So anyway, I know. I warned you folks, it's not going to be barn burners. It's simple stuff for people that are new. All right, the last bit of business is the Fibonacci. Okay, so anchor your fib to 2 price points. Get this off here. All right, so once you have it on your chart, highlight it, and then go to the little gear, and go to style. In style, these are the settings. Okay, all you do is go in, click the little box here, type in the numbers you see, just like I have here.
He really was a line. Next episode.
All right, folks. I'm going to take a look at the E-mini Micro NASDAQ 100 index. Okay, and I'll show you the imbalance right here. This is the initial one. You can always imagine it could style up into the second one, which it's really essentially just done now. So that could be a sell. I'd like to see it come down here first. I'll outline this as I go.
What's going on here? You just went straight into it.
All right, folks. I'm going to take a look at the E-mini Micro NASDAQ 100 index. Okay, and I'll show you the imbalance right here. This is the initial one. You can always imagine it could style up into the second one, which it's really essentially just done now. So that could be a sell. I'd like to see it come down here first. I'll outline this as I go. This is kind of the end of the road for the drop down before it runs Tuesday's highs. That's what I'm thinking. This is FOMC. I waited a few minutes for it to do its initial shakeout. So this is the end of the race lower. That's a little checkered flag here. Notice I have that, so it's not like me talking after the fact. You can see I'm doing everything here. There's where we're looking for it to drop down in and run out the Tuesday highs that I was mentioning on my community post. So I'll look for the trade down here. Now it could sweep a little bit below that because to the left of that imbalance that I'm highlighted in turquoise. There's the sell side pretty cool resting just below it, but for now I'm just focusing there. So it could drop down into that level. Now there's a couple ways to use this information. You can do a trade here with your demo account, compliance reasons, and look for it to run out the short-term low, and or wait for it to potentially trade up into the higher time frame fair value gap. And the reason why you could potentially wait for that is because it's FOMC. It has like a knee-jerk reaction, kind of like non-farm payroll. There's an initial leg, then another leg, then it's like a fake out leg, and then a real setup comes, which is what I'm outlining here in that blue shaded area. So I'm noticing that it's likely to draw down here, so I'm drawing this out so we can see the diagram is dropping. Okay, the idea is to drop down here first, is the quick move I'm looking for, then to run through Tuesday's high. All right, so it should start dropping in here. I don't want to see it go too much more than that because that would upset the fair value gap that is not yet traded into. I think that's going to be the next real drop. So right here's where I'm thinking initially. There's sell side resting right below that low. So you could get a short here. Your stop would be right above that most recent green candle to the left of it right now. And you can see there's no replay button being used here. The candles are painting. The replay button is dim. It's not even a thing with me. That's not true, knows it. I did recently in the mentorship video use the replay button, but I felt awkward enough for someone to do it just to be funny. So here's the drop down in here. Now I can revisit the bottom end of that fair value gap and bump it. Kind of like a support resistance idea. And that would be a shorting opportunity if it were to do that. And again, the stop would be placed at the high of the most recent green candle to the left. Right there. See that? That's a short right there. Okay, the market is like to keep dropping here. I'm looking for that little bullseye, that blue bullseye right below that short-term low. And that blue line, if you notice when I first started recording here, that was really just an order block. So it could bounce there a little bit. But ultimately, my interest is from where we are now down into that checkered flag area. And it doesn't look like I got enough room, so I'm going to probably have to move that over to the right a little bit. And again, the mindset is for dropping down. Okay, even though it really initially just ran the Tuesday high, but it's done shallow. Okay, the vocabulary I'm using here is running the Tuesday high, not sweeping the Tuesday high. The difference between sweeping would be like what's done here. That would be a sweep. It's a real shallow little run above that red line. That's Tuesday's high. Okay, so it swept that, and then we're coming back down post FOMC. So kind of like look at this move here we're making, and if it can drop down to that blue shaded area, it might just, if I'm wrong, it might just go down to that little bullseye and then run higher from there. I'm hoping it doesn't do that. I want to see it trade down into that blue shaded area, a little checkered flag. So that's like the end of the race for bears. They get into that, then it should start the real move higher, running Tuesday high. Running Tuesday high means it runs right over top of it and it just doesn't look back. Sweeping is where it just goes above or below or low or high. You know what I mean? Like if we're going to sweep high side, that means it's going to go up a little bit and then go down in reverse. Okay. They get into that, then it should start the real move higher, running Tuesday high. Running Tuesday high means it runs right over top of it and it just doesn't look back. Sweeping is where it just goes above or below or low or high. You know what I mean? Like if we're going to sweep high side, that means it's going to go up a little bit and then go down in reverse. Okay. If I'm saying we're going to run an old high or relatively equal high, that means we're going to run through it and continue. So that way there's a little bit of understanding here what I'm saying when I say that. I try to pick my words carefully so that we understand the distinction between what I'm expecting as a sweep and reverse back into the range for expansion move where I think if we can get down here, I'm going to scrub this over because you can see we're running out of space here. It might take a little bit more candles than I first thought. Yep, let me get this back here. There we are. Yep, there it is. This thing, I'm telling you, I look like a noob. I see this noob. All right, so we'll see if we can drop down into that. And I have to make another video for my mentorship group, so I gotta get started on that one. So here's a bearish order block. You can come back and hit that and resume going lower. All right, not bad, not bad. Let's see if she loves me. You can see, no replay button. Everything's dynamic here. All right, about to run into that sell side liquidity pool. Just anchor this here so you can see visually when it drops below it. Change the color here, so a little lighter than that one. Let's do light. All right, that's good enough. So you can see, I'll take this off here. All right, and there you go. And I'll come back to this in a moment. All right, as you can see, the market did in fact trade down. Look at the bodies of the candles respecting that blue shaded area. Really, really handsome price delivery. And it dipped down a little bit below, but that's fine. I'm not worried about being that accurate. The main thing is going down to that area, it turns and then runs Tuesday high. Look how much more dynamic that is. Now, what I did was I took the low at the turn after it made its run into that little blue shaded area. Once it started rallying and it took out the swing high around that 13,150, basically cross back over with some price delivery. So here, so you can see visually when it drops below it. Change the color here, so a little bit lighter than that one. Oops, too light. Okay, that's good enough. That we can see. I'll take this off here. All right, and there you go. Now I'll come back to this in a moment. All right, as you can see, the market did in fact trade down. Look at the bodies of candles respecting that blue shaded area. Really, really handsome price delivery. And it dipped down a little bit below, but that's fine. I'm not worried about being that accurate. The main thing is going down to that area, it turns and then runs Tuesday's high. Look how much more dynamic that is. Now, what I did was I took the low at the turn after it made its run into that little blue shaded area. Once it started rallying and it took out the swing high around that 13,150, basically crossed back over the fair value gap is the large one it dropped down into. Once it trades above that, then I'm going to use the high initially at the 2 o'clock hour down to the low post 2:30. That range I'm using the Fibonacci to expand up to a target, and it came up to 13,437 even. I'm just waiting for it to hit that, and once it does, then I'll go into the Fibonacci. I'll show you what this looked like, how I measured it, and all that. But hopefully you can see that it's done the majority of the move, which was outlined on the community tab before I just did the video. I did the video here, marking it up that we can see it wasn't a replay thing, it wasn't something after the fact. It's something that I'm teaching you all here. Now, the question mark at the bottom lower left-hand corner, what that's anchoring is the high that was formed at 2 o'clock, or what would be shown as 1400 here on the chart, down to that low where the question mark is. So what you're doing is you're doing a measurement of the range. Okay, where's 50% of that? Below 50% is where that fair value gap is. That's in turquoise. So that's the target's dropping down into it. So it's a matter of looking at this. And really, there's technically, there's 1, 2, 3, 4, 5, 6, 7, 8. There's 8 trades in this whole entire thing. So once it trades this level here, I'm looking for it to hit that, and then I'll go in and kind of show you some things about what I'm referring to as the 8 setups. And this might not be the real setup that you would be looking for. It might be something, one of the 8 that I'll show you. But that's the unique idea that I want you to adopt as a student of mine. I don't want you all thinking, well, we all have to have the same setup. No, you don't have to have the same setup. In fact, you're not. You're going to come to the conclusion that the things that you're looking for are going to be much more important when it's uniquely selected, not me pushing you into a mode saying this is how it's going to work every single time just for you, because it's not going to work that way. So you have to find a way to grow comfortable with the concepts and how that applies to the present market conditions and how you select your setup. And I'll show you 8 of them in here. That way you'll know that this is what you're looking for and it fits your criteria. And you may not take any of the other 7 out of the 8. But the main one here is obviously the one I highlighted. It's the one that is the highest form of analysis that we can see exactly where it's going to draw to before it turns around. So you can couple what I've shown you here with what I've outright told you basically that I'm looking for the drop down to FOMC at 2 o'clock. Once it drops down into that, usually around 2:30, it's finished its initial leg where it prices in whatever it's going to do, either high or low, and it starts to rally. So you can see it's pretty much close to that in terms of growth delivery. I just looked at past 2:30. We're about ready to hit that target here, and there she is. All right, so let's dim that out, and I'll take you over to the fib portion. I'll explain everything to you that way. All right, so now obviously I'm going to take you back in. I'll use the fib here, and what I'm doing is anchoring to the high down to the low. And this is the most extreme. Now, usually I'll use the highest opener close and the lowest opener close in the price swing when it's not expected to have a whole lot of volatility, because it's the FOMC. It's more likely to be much more volatile. That means the extreme of the ranges should be considered. That means now I'm going to use the wicks. You ask a lot all the time, in the comments, like, why does ITC use the wicks and why does he use the bodies and what does he differentiate? I just taught you. Okay, so I'll show you 2 forms of that, and actually this backwards too. Portion, I'll explain everything to you that way. All right, so now obviously I'm going to take you back in. I'm going to use the fib here, and what I'm doing is anchoring to the high down to the low. And this is the most extreme. Now, usually I'll use the highest opener close and the lowest opener close in the price swing when it's not expected to have a whole lot of volatility, because it's the FOMC. It's more likely to be much more volatile. That means the extreme of the ranges should be considered. That means now I'm going to use the wicks. You ask a lot all the time, in the comments, like, why does ITC use the wicks and why does he use the bodies and what does he differentiate? I just taught you. Okay, so I'll show you 2 forms of that, and actually this backwards too. I'm draw it from the low up to the high. I'm looking for upside objectives. Okay, so low up to high. Here's 1 objective. Here's 2 objectives, and now we're just falling short of that one. Okay, so that's kind of the extreme target for me today. But if you look at the body to body, it'll make a whole lot more sense in a moment. There's that target I was looking for right there in the early portion of the recording. Okay. Fair value gap. Initial one here drops down, hits the order block, which is that blue line here. It bounced up into the fair value gap. This is what I was suggesting. This is going to be the main one. So it's a run on liquidity, drop down, start to drop even lower, hit an order block, then rallies up, hits the fair value gap. That sets the stage for the decline down into the area I highlighted in advance. Said this was the end of the road for theirs. Starts to rally, comes back down in, rallies once more, takes out Tuesday's high much more meaningfully, and rallies again, pulls back into an inbounds here, rallies again, pulls back into an inbounds here after taking our target, and even continues to go high from there. Okay, so let's take a look at some of the trades. You got the run here ahead of FOMC, that I would not count. Okay, that's a setup, but that's a gambler's setup. It's before the FOMC announcement. So we have the drop down, then the fair value gap here. So that's trade 1. We return back to the fair value gap here. That's trade 2. Drops down in below here. You close your short if it's a scalp. Here is a long idea as a scalp. It takes us up into offset liquidity resting above this high here, and then into the fair value gap that sets up the short down into the objective I was looking for. Now, right away, some of you are thinking, man, I'm not Spider-Man. How do you expect me to take all these trades? I'm not, folks. I'm not. Any one of these things that I'm outlining here could be a specific setup that fits your unique model. Okay, that meets the criteria you're looking for. Then drop down here. That's a buy. And you can show you this here as an order block there. Rallies up and it comes back down into the order block. These 2 down close candles here. Because now this is where I said we were going to turn. And I said we're going to run Tuesday's highs. Now I sweep them like this. It's going to run them. Okay, so we're going to right over top of them here. So it rallies up, comes back down in, retracement, rallies again, small little imbalance. You can be a buyer there, rallies. And again here, this is one that I didn't obviously mention, see, because I stopped recording as it ran through here on our objective. Okay, and I think that's going to be it. So I don't want you thinking this is an invitation for you to try to trade FOMC or like a non-farm payroll event. They're very, very risky, extremely risky, but they're really fun to go back into and study from a hindsight perspective. Or if you can watch it live, it's a wonderful case study that we can look at how the is taken, how it runs through the other extreme of the range, and how it starts to deliver its order flow. All down close candles should be supporting prices as it goes up and running out Tuesday's high in a much more meaningful manner. Hopefully you found this one insightful. Until next time, be safe. The real lesson. You're entitled to your opinion, but if your All right, folks, welcome back. This is going to be episode 24 of the continuing series of the free ICT mentorship on YouTube for 2022. All right, so I want to kind of like sit you down for a minute, get your attention, because if you don't have the proper mindset for this one, this could be taken out of context and viewed in a light that is not really my aim, okay? So I want you to think about, why are you even watching these videos? Are you trying to learn? Are you just entertaining yourself? Or are you here to try to be disruptive? Because if you're trying to be disruptive, I don't have any time for that. So I want you to understand what I'm going to show in this video. This is not going to be a repeating theme. I just want to let the foundation be laid here. If I see any comments that are either disrespectful or just meant to stir up chaos and create a ruckus, I'm just going to ban you from the channel and your post won't appear, okay? The comment section is open. You guys said I don't open the comments up. I've been opening them up. All mentorship videos are open, okay? I use your comments to steer the future direction of the lessons. I try to incorporate things that you may have asked or shown a concern about respectfully. If this is not for you, then obviously you can go watch Tom, Dick, and Harry go play Market Replay. Okay, that's fine. But here, I'm teaching you things that actually work in the live markets. I'm not pulling some strings that make you feel like you're running something that is a gimmick. This is real market delivery. Those of you that are really sincere about learning, obviously, you have a lot of work ahead of you. And we are in the development stages early on in this mentorship. So that means you have to understand.
So in 2022, he had 230,000 subscribers. Wow, dude. Was this his private? No, this is YouTube. So in 4 years, he's gone to 2 million.
This is
nice.
Discovery, where you see this pattern. You're supposed to be going back through the data in your old charts, not trading, not even demo trading. Okay, you're looking for this pattern through backtesting. Now, some of you have asked to do a backtesting episode. I will do a backtesting episode. Okay, but I want you to understand that you have to have the proper mindset here. You have to be responsible. You have to be attentive, and you have to listen. So the things I'm teaching, the things I'm saying, suggesting to you, you have to make them applicable to your own journey. You can't just watch and think, okay, I've seen him do this a few times in the video. I understand it, so I'm going to go back and try to do it. So I want you to understand, in light of that idea or direction that some of you want to take, just know that that's not the proper way of doing it, okay? So some of you are unaware that this is the other part of the ICT experience. When I'm communicating to the community here, not only am I doing it in the comment section, very, very rarely, but I also talk on the community posts. And if you go on YouTube, go to my YouTube channel, and click on this little area right here, you'll see it's kind of like my Twitter, like my update area. Sometimes I'll prompt you to look at certain charts, or I'll encourage you, give you ideas to think about, where you are in your journey. And sometimes I'll share a YouTube channel for a specific video. It's not meant for you to be able to talk to me here, but you can obviously say anything you want in the comment section. Just know that if it's something that's disrespectful, you can say whatever you want on your last post, okay? Because I'll just make you invisible. You won't be here anymore. And you can keep creating accounts. I don't care. It just takes one little click of a button for me. You got to go through a whole freaking row of email addresses and all that business. And I don't get tired of clicking hitting ban. I don't get tired of doing it. It's real easy. In fact, it's fun. But this area here is the other segment of mentorship. So with that in mind, I made this post a little while ago, and today's date is May 5th, 2022. And I know some of you try to remind me to make these posts with the date, and I just don't remember it. So I'm used to doing Twitter, and Twitter used to do a time and date stamp all the time. It's just, I'm a creature of habit like anybody else. I don't really think about it when I'm doing it. But I made this post this morning. I said, good morning, constant reader. I know, right? That FOMC was pretty hot. Now try this one. Open your NASDAQ 15-minute chart and even the S&P 15-minute charts. Drop a horizontal line across those smooth criminal highs in both index. I'll explain what that is in a moment. See how we dropped into a discount overnight. Study how they treat those relative equal highs today and non-farm payroll Friday. As you work. So I'm encouraging all of you to open up your charts and interact. Because some of you just want to watch my videos and that's it, and think it's going to translate from just watching and then now you know how to do it. No, you got to get in and study it. So I prompted everyone to look at their chart, and it's kind of what I'll draw your attention to. Now, as one caveat here, that little blue arrow, that is me drawing the specific. So that way we know what we're talking about here, where my attention was really drawn in on this. I'm watching this. Got that little bubble there. That little gap right there, I'm watching and I'm waiting for that to drop down at 9:30. That's that little Judas swing. Okay, I'm waiting for that Judas swing to happen where it drops down at 9:30. If it goes into that area there, and then it creates displacement. Then it looks for a fair value gap. And if it trades back down into a fair value gap inside that displacement, then I can go long and I'll look for a run into that 43.03. Okay. I did not tell my mentorship last night that I wanted to do this very thing here. But if I was going to tell my mentorship anything, this is what I would have said. Okay, I would like to see it drop down into that area and then create the model that I'm teaching here on the YouTube channel. Now, read what it says here. It says, you are studying this, and I am watching this. Okay? Pray tell, does this in any manner whatsoever suggest, in any manner at all, that any of you should be buying or selling this? No, it doesn't. For years, I've been asked to do live sessions. I've been asked to trade live in front of people, okay? The number one reason why I have refrained from doing it is what we're going to talk about next. Because responsibility is lacking, predominantly across all countries, all age and demographics. It's simply something that most people in trading lack. Okay. Now it's going to be very easy for me to sit in front of a chart and say, this is what I think is going to happen. I think it might go up to this level, go down to that level. That is not a trade idea. That's just bias. It's logic. That's the extent of what I'm going to do in the live sessions. The reason why I already said that in the beginning, and I didn't change gears because of what I'm going to talk about tonight, but it's important. Okay. Mindset is absolutely crucial. If you young guys and gals in here are already bored, do yourself a favor. Turn this video off. Don't ever watch another video by me, because you're going to cheat yourself from the absolute best prevention of ruin. If you continuously try to just watch my videos, pay intermittent attention, and then think you're going to glean any real understanding, because this is highly technical. I have simplified it, and you're going to see two very simplified approaches to what I'm trying to teach, so that way I can get right to the point. But these are the parts that cause people that don't want to listen, that don't want to pay the attention to the things I'm teaching you. These are the parts that will hurt you if you don't understand it. Do you want to succeed? Because to succeed, you need this part. Not the little patterns, not the little things I can draw on a chart. That stuff, that's the smallest part of it. How you think about yourself, what you think you're capable of doing, and the management and observation and respect of risk is going to determine what your success is going to be. I wish I could grab you by your lapels and just shake you and say, listen, this is the part you need to learn. It's not full of Lamborghinis. It's not full of Patek Philippe watches and flossing in front of everybody. I talk to you this way because I genuinely care about your success. That's all. That's all I want you to be able to do is take this information, the logic, and do well with it. I'm not trying to bore you or burn through minutes just for the sake of hearing myself talk. I want you to understand. And some of you simply don't want to listen. You have to be a critical thinker. I'm training you to be a critical thinker. I'm going to give you 2 examples tonight of what critical thinking is not. All right, this individual here was in the comment section, okay? And this is the poster child for why I do not sit in front of people and trade with entry, stop, targets. I don't do that. Because invariably,
just lost 1K, thanks a lot.
someone's going to take something I'm doing or saying or applying to a chart, and they're going to do something with live funds, and they're going to come out and say, just lost 1,000, thanks a lot. Now, I don't know who this person is. This person may not have actually taken a trade and lost money. This person may be a troll. This person may be a genuinely sincere individual. At this point, I don't care. But I want to highlight, this is the very thing, folks. This is it. This is the thing that prevented me all these years to sit in front of all you and entertain you with trading. Because someone's going to do something, and when they do something by their own actions, and it's painful for them, they lose money. Guess whose fault that is? Because it's not mine. It's the person that lost the money. Listen, everything I teach here is under the guise of demo and paper trading. That's compliance. I don't give trade advice. I can talk about where the market's going to go. I can give my opinion about that. Market opinions, that's not trade advice. It's the same logic, the same idea, and the same language that all of my paid mentorship students sign an agreement and they give me indemnity. They know going in that everything I'm saying is under the pretense of demo and paper trading, and you can't make money with demo trading. But guess what? You can't do either. You can't lose money either. So it gives you that freedom to think about what you're doing without the tug of war of making and losing money. Some of you in here are so high-strung and so impatient that you just want to go out there and say, okay, I'm going to watch this video. I'm going to get a hint from ICT like I'm doing some kind of secret language for a signal service. And I say this stuff to my own paid mentorship. I said it for 6 years. Every time there's a new group coming in, and know there's no new group coming in, and stop listening to these yahoos out there saying that I'm going to start another mentorship and I'm not selling no more mentorships, folks, because of this kind of stuff. Okay, I'm not doing it. So whether this person lost $1,000 or didn't, I don't care. That right there is why I have prevented myself saying, nope, I'm not going to do it. Because I know there's going to be a lot of you out here that are going to hurt yourself because you're not ready. None of you should be trading this model with live funds. We haven't even gotten through all of the content or the process of what it is you're doing with it. Today, you're doing another piece of it, but this is the crucial part. This is the stuff, the boring stuff, the things that you don't want to listen to, the things that you want to go through, the people that want to come in here later on and say, here's a minute marker when you start really teaching and you want to avoid the crap. I will delete your posts if you do stuff like that. It's disrespectful not only to me, but the other viewers, because you're really taking their attention away from what is the real lesson. They're on to your opinion, but if your opinion is disruptive or disrespectful, I won't let it post. Now, you can disagree respectfully, and those posts stay on the comment section. But nonsense that's meant to start a ruckus, your channel will be blocked. Then you have folks like this, who cannot be taught. Now again, this could be a troll.
Don't post a chart that doesn't explain, then disappear. It costs many of us for money. If that's what you meant by live streaming, then we don't need the confusion. Keep the charts. Facts.
This could be someone that didn't really take a trade today, because really the logic, as I'm going to prove tonight, really wasn't in the marketplace today for this model. And it can't be argued. There's no way you're going to be able to say that what I posted this morning is lined up with any of the logic that this model uses. So, again, this person may have done something foolish, or maybe they're just here to troll. That's fine. It doesn't matter, because the posts that were made even after this indicate that the person's really not properly prepared to learn how to do this, and or really not interested in learning. So they're going to get removed. They may come back in another form, but any disrespectful comment will be removed. This statement right down here at the bottom, highlighted, take accountability for your actions. If you're taking trades, number one, you gotta take accountability for your actions. Those are your actions. I didn't reach through the screen. I didn't go to your house. I didn't go to your apartment. I didn't meet you at your job and press your cell phone to get you into a trade. In fact, I didn't tell anybody about a trade. I said, study, watch. I'm watching this. Okay? That is not indications. That's not instructions to buy or sell anything. So don't get caught up in all this frenzy to be pushing any buttons yet, because none of you know what you're doing. All right, I appreciate your patience getting through that. I get it off my chest, and I promise I won't do it again, because it's already done here. Just know that if you act like those individuals, I won't see your posts. All right, so E-mini S&P, we won't cover tonight, but it's kind of similar to what this is shown here. But the E-mini NASDAQ 100 futures June contract delivery month, 2022. This is the daily chart. And I felt that this morning we could have popped through, stabbed above these relative equal highs right in here, and then created this run lower. That's kind of like what I was prompting. Study that, because if it happens, you can see and study and backtest. Now that the market's already moved, you can go back in and look and see if the model in fact did what I teach. Now, this is actually a good lesson because it shows where I'm looking for something to form, but it doesn't form. It doesn't create a losing trade. It doesn't get me into something that causes me to buy it when there really isn't an entry pattern there. This is the proof, the evidence that the model has validity. So if you have a valid, reasonable, sound logic behind the model, whatever model that is, then it should prevent you from taking bad trades. Not all the time, but sometimes when there is a really big move going in the other direction that you don't see or expect, it may do its job and keep you from getting into those bad trades. And I'll show you the logic here today. I want you to be a critical thinker, okay? Think about what I've already taught about this model. In the comment section below, If you think that this model appeared based on what I showed in that community post, say so. If you don't think that this model appeared based on what I showed, then say so as well. Also, I'd appreciate if you include in your post, where are you all from, folks? Like, I want to get a kind of a broad range view of how far I'm reaching. I know I got a lot of people in different countries, but all you do is tell me what country you're from. You don't have to be specific with your address or social security number. I'm not that interested. But I would like to know, where everyone's from. But here's the logic with that 1 hour chart and at relative equal high. So this is the framework I'm looking for a run above here. If it can get above that, then what? We could have popped through, stabbed above these relative equal highs right in here, and then created this run lower. That's kind of like what I was prompting. Study that, because if it happens, you can see and study in backtest. Now that the market's already moved, you can go back in and look and see if the model in fact did what I teach. Now, this is actually a good lesson because it shows where I'm looking for something to form, but it doesn't form. It doesn't create a losing trade. It doesn't get me into something that causes me to buy it when there really isn't an entry pattern there. This is the proof, the evidence that the model has validity. So if you have a valid, reasonable, sound logic behind the model, whatever model that is, then it should prevent you from taking bad trades. Not all the time, but sometimes when there is a really big move going the other direction that you don't see or expect, it may do its job and keep you from getting into those bad trades. And I'll show you.
Mic check 1 2. Mic check 1 2. Mic check 1 2. Are you working? Hello, hello. I am trying to voice type. Hello, hello. One, two, 1 2, 1 2. 1 2. Don't write this up. Oh, really? One, two, 1 2, 1 2. Are we working? Answers no. Anyway.
That's kind of like what I was prompting. Study that, because if it happens, you can see and study in backtest. Now that the market's already moved, you can go back in and look and see if the model in fact did what I teach. Now, this is actually a good lesson because it shows where I'm looking for something to form, but it doesn't form. It doesn't create a losing trade. It doesn't get me into something that causes me to buy it when there really isn't an entry pattern there. This is the proof, the evidence that the model has validity. So if you have a valid, reasonable, sound logic behind the model, whatever model that is, then it should prevent you from taking bad trades. Not all the time, but sometimes when there is a really big move going the other direction that you don't see or expect, it may do its job and keep you from getting into those bad trades. And I'll show you the logic here today. I want you to be a critical thinker, okay? Think about what I've already taught about this model. In the comment section below, if you think that this model appeared based on what I showed in that community post, say so. If you don't think that this model appeared based on what I showed, then say so as well. Also, I'd appreciate if you include in your post, where are you all from, folks? Like, I want to get a kind of a broad range view of how far I'm reaching. I know I got a lot of people in different countries, but all you do is tell me what country you're from. You don't have to be specific with your address or social security number. I'm not that interested. But I would like to know, where everyone's from. But here's the logic with that 1 hour chart and at relative equal high. So this is the framework I'm looking for a run above here. If it can get above that, then what? It could wash out and go lower. Why would that be possible in terms of a pattern or a setup or a logic? What would be the catalyst for that? What was the reason for you being interested in these relative equal highs? Number one, it's Thursday. It's Thursday and it's ahead of non-farm payroll Friday. Now, non-farm payroll Friday is usually a volatile day. It can be messy, it can be sloppy. Sometimes it's just a dud. It doesn't really do anything. Other days it could be extremely volatile, like the FOMC. But because the FOMC has done what it's done, I don't think that the non-farm payroll numbers are going to have that much impact. But I was looking for these relative equal highs to be taken out, then drop lower, then create the model that I'm teaching. That's why I was kind of drawing your attention to them, so that way if it did present that, you can have something to study. Now, what's the catalyst that sets the run up into those relative equal highs? I'm going to talk about that now. Much like I was suggesting,
So, let's do this one thing first, and then I'll move on. Remember, this lesson is a good lesson. This is easy to.
in that post, we had dropped down into a discount. I posted ahead of the 9:30 opening where equities open up, and that volatility that comes around 9:30, I want to see some kind of manipulation in price. So if our focus, and I was trying to get your attention up here, if our focus is up there and it's dropping down and it's ahead of 9:30, what are we likely to see? Drop down, get traders thinking it's going to go lower, and then rally up. Not just go down indiscriminately and then go higher. It's got to do something specific. I'm interested in this area right here. That's why I posted in that community post saying I'm watching this, and it was that little area right here. For all of these videos that I've been posting, it's very specific. I'm teaching fair value gap. That fair value gap is right there. Okay, so dropping down into that, that would be a point of interest for me, so that I can go in and look for something that gives me my setup. So in other words, this here is just where the trade might form. Hear what I said? Where the trade might. It could. It may. Not it's absolutely going to. This is a promise. There's no way this can fail because that logic doesn't exist in trading except for over leverage and over trade. You're going to blow your account. That's a guarantee. Okay. But that fair value gap, that's the place in terms of price. Where should the pattern form? By itself, it's just price. But we have to incorporate what element first. Algorithmically, it's time. So I'm teaching you elements of time at that 9:30. We're expecting some volatility. Dropping down into that area here, which at this point of the chart, it doesn't do yet. So I'm looking for it to drop down into that area. If it does, then I'm going to be looking for what I teach you in this model. So with that area shaded right here, this is a 15-minute chart. You can see we traded down into it. The candle stopped right at the old candle high. And the next candle just gave up the ghost. Right away, we should notice that we did have the initial criteria, which is trading below an old low. So what's going to be resting below that sell stops. So they go down, run out the sell stops. Traders are caught in. Then what? What's the next logic? We got to look for displacement. It's got to trade back above this old low. It's got to have displacement above that. Did it happen here? No. Here is a 5-minute chart. Now, if you're looking at this with that same low here, it trades down below it. Did we get displacement above that old low? No. It just went down, consolidated, returned back.
Okay, so I'm just trying to, obviously you can tell when I'm kind of understanding what he's saying, or he's saying things I've already heard before, like when he was doing the talking about people's mental posture when it comes to watching his videos, etc. And he's going through the comics. I go to this document, which is where we started, and I tried to convert it. Now I like the look of docs, like it looks clean to me, just because like there's no space, there's so much space on either side, as opposed to here. It just looks, the UI looks better. Maybe it might be because it's full screen, but anyway, I was prior doing on docs, right? I want to send as a PDF, whatever it may be. Slides, obviously, it took a lot of setup to get it like this because it's normally horizontal, emulating PowerPoint, and I don't like speaker notes. Let's get rid of that. All right, so it's kind of like what docs feels like right here, and also blue is better than yellow for me. So that's the icon. So with that being said, I had everything here, but the issue with this is that it's very picky, like with these circles and creating some lines. Like it takes a lot of effort. I have to literally draw it. So I think there's a thing. I have to draw it here and then import it as an image. So like I have to draw the line first, and here it's tough to get it looking like how I want, right? Because it doesn't, you can't keep it straight. Well, you can, but you can't keep it as you want. When you create it, then it turns into an image, and then you have to put it and line up, which I didn't like, right? So that's why I went to slides, because you can draw lines, you can get a bit more involved in creating, and it's a lot cleaner. That's the main reason for the transition. But anyway, the episode that we're on, it's currently talking about a model of entry that can keep you from losses. And when you have your bias, he had this bias of it going up. Obviously, he was expecting it to target the liquidity above. As you can see from here, oh, this is not the right episodes. You can see from here, was expecting, he said here, we have a chart here that we're expecting price to stab the buy side liquidity. 1, 2, right? But you can see we didn't do that. So he's expecting the next candlestick to be bullish. So he has a bullish bias. So because of that expectation, we're now relying on the model after that, because the model will be the entry model, which is everything we need before we enter price. So just because we have something bullish doesn't mean we just enter a random bullish fair value gap. Our price gets this bullish fair value gap, we're in, which is kind of the mistake we made with this first entry. Like you can see here, we're bullish. We're expecting price to be bullish, and this is Euro USD. It didn't even become bullish. It technically didn't reach, but we expected price. Get rid of this. We was expecting price to reach this buy side liquidity from here, and yeah, it went up. Didn't take our liquidity, and it came back down. So it's left that liquidity alone. But one thing that we know is that it didn't take the liquidity, right? So if we zoom in a bit onto the market, this is a trade we took last time, right? And you can see it ended up hitting stop loss. First of all, we marked this source of liquidity out. I just didn't think it would target it as quickly. This red line is just the upper echelon of the order block, which we lined up with the fair value gap. So this doesn't actually need to exist because it can be confusing. For the source of liquidity, we can change color, but let's actually change the color to, let's say, yellow. That is disgusting. Sorry. like a darker green. That's nice. So that's the order block of a bound. That's the entry that we got in, which is random. We was trying to enter here, but it was multitasking, so we got in a little bit earlier. Then we have this our stop loss. Why is it here? Because 1, 2, 3, those are 3 candlesticks. We set a stop loss below the first candlestick contributing to the fair value gap. So that's why our stop loss was here. We also realized that there's some sell side liquidity here from what? 1, 2 areas of lows. They weren't equal lows. At least I didn't see it as such. And you see this lines up with this fair value gap. But anyway, we swept the fair value gap just by a couple of pips and we swept this low. So there was some manipulation here. Another thing we did is that we got in around 8:30, but we need to be cautious because around this 8:30 we have session open here. But what else do we know? We tend to be getting in around 9:30. 9:30 we're expecting some manipulation. So this move to the downside was the manipulation to then move higher. So we got in too early, number one. Number two, we didn't actually wait. I think I was getting in thinking that okay, so London session was bullish, right? I thought, okay, you know what, New York is going to continue that to this buy side. So my entry was more like a compound, even though it was initial entry. I treated it like a compound, which was that I'm a little bit lenient. I'm very confident in my bias, right? But we had this overall sell side, this overall buy side. I just thought this buy side was a bit stronger and would pull price in. So I'm just basically going off of this because it's a live trade that we took and you can see it's live. Look, I'm very honest with all of my losses. I don't hide anything. I posted it at 1:40 in the afternoon as the idea. Obviously, it wasn't formed yet, but it was prematurely what I was looking for. So I'm trying to think when price came back down to fair value gap. Hold on. We hadn't taken liquidity. Hold on. I think we should have waited potentially for liquidity to get taken down here. Then we have a shift. We then have a shift over here. We wait for price to come back in, which it didn't. Okay, I will need to fine tune the idea because I'm now, when you get the analysis paralysis, I'm thinking of so many different things. I'm thinking of a power 3. And I'm thinking, okay, wait, I'm not allowed to enter just on the retouch of a fair value gap? And when am I allowed to do that? And then it's like, okay, cool. When do I have the model of the pullback in the fair value gap? Or the market should the shift? But this is even the market. I guess you have a market should the shift over here. And then it's like, oh my gosh, there's so much information going through my brain right now. Let's finish this. And then we can fine tune later because, yeah, I feel the analysis paralysis.
To it, but melted. Didn't do anything about that. Oh no.
So let's pay attention here because he's going through the entry. So we can
right here.
utilize that for our advantage.
Into that area here, which at this point of the chart it doesn't do yet. So I'm looking for it to drop down into that area. If it does, then I'm going to be looking for what I teach you in this model. So with that area shaded right here, this is a 15-minute chart. You can see we traded down into it. The candle stopped right at the old candle high, and the next candle just gave up ghost. Right away, we should notice that we did have the initial criteria, which is trading below an old low. So what's going to be resting below that sell stops? So they go down, run out the sell stops. Traders are caught in. Then what? What's the next logic? We have look for displacement. It's got to trade back above.
This is a bad entry. Here we can have.
Of this old low. It's got to have displacement above that. Did it happen here? No. Here is a 5-minute chart. Now, if you're looking at this with that same low here, it trades down below it. Did we get displacement above that old low? No. It just went down, consolidated, returned back to it, but melted. Didn't do anything above that old low. There was no displacement, no energetic move, so that way you can look for a fair value gap to trade back down into the buy. So anyone that would have looked at this and bought today is not using what I'm teaching. They're just impulsively pushing a button. And if they lost money, you have to fault yourself for that. I'm not going to
What I realized is that it's like a nesting of the same model that produces the entry, where we enter, and how we enter. For example, we successfully here located where, right? We want to enter here. What we didn't get is how, because where is the location? Okay, when price gets this location, does it do the correct things at the correct time? So it comes to 930, which is the area of volatility. We then have a market displacement to the downside. We trade below that, success. Okay, then we need a displacement upwards, success. It produces some fair value gaps, one here, and we wait for price to come back to it to then enter. We didn't get that, and so therefore we wouldn't have got an entry and would have saved the money we lost. So we need to use the model to find where and then how. How is this? Where is this? And that's what he was looking. He found where before he was looking for the how. It's a bit different because it's not the where and the how are different. For example, although I say we use the models to get here, how, and we use the models to get where, or where and how, the where has different criteria than the how. The where is okay, time, area of interest, which would be the value gap imbalance, psychological level, liquidity areas, those types of area of interest, not support resistance, right? Supply demand, not those type of things. So once we then have that, we have the where, we had the order block, we had the fair value gap, we had the context, the context of the aim, we had the power three, the distribution or the expansion, we had the continuation. We now needed another reason to enter. If we was in London or going around here, we could have then probably held comfortably over here. So the where is as attributed to those things we're looking for. Then the how is okay, sweep, displace, retrace, enter. And that is the how. We need to really hone in on that. And that's one of the first things I wrote. If you see here, episode intro, sweep, displace, retrace, enter. That's the basics of how to enter. In fact, I'm even going to put it, to be fair, we have it back in here. Let me go to episode 1 or slide 1. To put it right here, how to enter. The where is linked to the bias a little bit because the bias is obviously direction, if it's up or down, but the systems that we use is similar. We use on a daily time frame the how to determine where price is going to go, or the direction price is going to go rather than where, because we don't always know, but the where price is going to go. Then we use that same, the things we use to determine is things like imbalances. We use liquidity as a magnet, resting liquidity like equal highs, equal lows. We also then use things like imbalances, fair value gaps. Sometimes, we utilize that even with tape reading and things like the Fibonacci, is it in discounts, in a premium between a range, etc. We use all of that to determine where. We kind of use that in a little way to determine where, and we know the direction, which is almost like where, but where is price going, and where is price potentially going to create an entry. Where price is going and where price is going to create an entry. Where price is going to create an entry, again, we're using fair value gap. We're using range. For example, BAM to BAM, this is around the discount between the top of this and the bottom of this range. Obviously, I can't really see it right now, but assuming it'll be near the discount or the equilibrium, right? We're also next to liquidity. So with that, we can say, you know what, because of liquidity being here, that's where price is going, and this is where there is some imbalance that price will get to, then we can go to the how. So it's an order of things. And that's why we entered this trade using some of the model, but not all of it. We got the where, that's fine. We didn't get the how. Because time is good, the location is good. We just missed the model. We needed to use almost the power 3 again, like we saw here, manipulation, accumulation, distribution. Same thing over here. From 830, manipulation, we got some displacement, and then this would have been the expansion, distribution. All right, so that's the power 3 again. Manipulation, accumulation, distribution, but we got in the manipulation. So that's one of the tags we can actually add to this. So I might update the website as well, because I did create some updates. Let me see. I think I can do it low key right now. Can't show you though. Actually, I need to download it. I know I did download it. Let me see if I can show you. All right, change everything to CJ. Wait, my show. Oh, that was a save. Okay, let's refresh. Bam. That's how you update the website. It's so easy. So I'll go through some of the changes we made later, sorry. So we entered during manipulation. Wait. Where is it? I'll just take the one from Telegram. Okay, so all right, we got this down. And you see, why I was able to learn this loss quicker, I lost real money, even though it's £7, which is not much. But guess what? It's real. That's what hurts. That's what makes me find out, okay, why did I lose? Why did I lose? Why did I lose? That's why I was able to learn and precisely find out the reason why. Now, my psychology is almost 10 out of 10. Like I would say it's as close to 10 out of 10 as it can be, right? So I know if I'm making a mistake, it's either one of a couple of things. Either it's a valid loss, like it's part of the strategy, everything looked like it was good, but it just was that it was wrong. It's not like if I looked at it now with hindsight, I made a mistake. Then there's those types of losses, which this could have been, and then there was a loss where it's like, I maybe misread the markets, I misanalyzed, I misinterpreted something, or made a mistake somewhere, and therefore I could then go back and trace the mistake. If I can't trace where the mistake is, either two things: one, I don't have the knowledge, or two, it's just a part of the strategy. And it's a dangerous thing to not know which one it is. But when you have a mentor who knows the model like the back of their hand, which is why we're trading during the learning of the mentorship, and that's why we gave ourselves the date. No matter how much we have learned of the documents, and this document that we made, we're going to revisit it multiple times. We're going to go through episodes that we feel like we don't understand something, go through it, find what we're looking for. I'm just trying to get through to obviously episode 41 so that I can then do that and then review my own journal and then create my own model from the model that he's taught us. And he's taught us like thousands of ways to get into markets, right? Oh no. What just happened? He shows multiple ways, and I say thousands like a
Move so that way you can look for a fair value gap to trade back down.
thingy. But he showed multiple ways to get into the markets using the model in different ways. So what does that mean? That means that you don't have to trade the same. We all have to trade the same. And because of that, we can then take the model, apply our own philosophy, take what we like from it, and structure it where it only supports those ideas that benefit us, so that we see clearly. And that's what I'm going to be doing after I finished. And we're going to be doing it kind of gradually as we're doing it, just so that we can gain mastery of the model itself and then utilize the model to our advantage. And now with hindsight, we would have had to wait for this displacement to happen. And you can see price didn't come back down to this fair value gap anyway. So we would have, in theory, missed the trade. And there's not really any entry for us. I don't know what this is for. Yeah, we ended up not taking out this liquidity, which is still there. And we created a bearish daily candle, though nearly came here. So if we actually look at this range right here. Okay. Why is it not staying still? Maybe it doesn't work for fibs. Look at this. You can see that we are at equilibrium. I did doji almost and didn't take out liquidity. We came from equilibrium on this big range right here. This swing low, technically it's not really swing high because we don't have anything to the right of it, but this high over here, this range, it's at equilibrium. Because at equilibrium, we're now deciding where will it go next. Well, we still have this liquidity up here. But we also have liquidity down here now. And it could literally go for either. Truly. It's more likely to go here because this has a high here and a high here. This failed higher high. But this could also be a sign for it to drop. I would have preferred, actually there was an example of this. Shout out to memory. There was an example where it was a failed higher high. It was in that one, it was around episode 18, 17. This is what we would want for sales, taking off the liquidity, but that's the hourly, right? But wait, there's something else I'm looking for. It was in this like little fair value gap he saw, and it was a failed higher high. And he drew a range, and it was at equilibrium. Is it? It's the daily time frame. Yeah, right here. It was episode 10, that's way back. This. So yeah, if you look here, we can see there's a range here, but we have a failed higher high. So although we didn't take out liquidity, failed higher high is the black circle, then they're taking of lows. They pull back into the value gap. So we kind of have that here almost, where it's a failed higher high, which could fuel these sells, especially when the fact that we are technically still in premiums and there's some sell side liquidity over here. I would have thought though that we of course would have taken this out. So we've gone for this sell side liquidity and there's some sell side down here. Maybe look for equal lows, something of the sort. Stay here for now. It's no longer sell side because it's just been taken out. Yeah, buy side and sell side. Make this closer to the price. This as well. Look at these. I feel like not really bothering anyone. It's just nice.
Down into the bottom. So anyone that would have looked at this and bought today is not using what I'm teaching. They're just impulsively pushing a button. And if they lost money, you have to fault yourself for that. I'm not going to be the target for all of you that fail, don't listen, and want to gamble. And when it doesn't work for you because you took a guess, you took a stab at it, you just want to see what was going to happen, and you lose money, You can never do that with me. Even my paid mentorships, those students, they can't do any of that either because I never tell them to go into anything and buy or sell anything. Nothing. I'm not going to co-sign your financial ruin. It ain't going to happen. None of this can be placed on me. The responsibility is solely on you, the viewer. And it's a lot of responsibility. And some of you simply are not going to be able to do this. Not because it doesn't work, but because you are not responsible. You don't have any self-control. You don't want to listen. You don't want to have any rules. And those rules, look at it like this, folks. In the videos, I'll suggest folks, hey, look, pause the video here, study, so that way you can really look for it before it's revealed. There's a lot of people, they make jokes and say, I'm not going to pause the video. I promise you, if they're sincere in their response saying that, I promise you, they will not learn this. Okay? It will not happen because they're showing a trait that is simply not conducive for success in doing this business. So it doesn't work like that. It's not easy. It's not Netflix and chill. It's ICT and study your ass off. Okay, that's the way it is. And it takes a lot of logic that you have to adhere to. And you have to break yourself. There's a lot of things you're going to try to do impulsively. If you do them here and it works for you and you make profits, you're going to be in here in the comment section high-fiving me. Yeah, we're killing ICT style. When in fact, you just got lucky. Because then the next time you take another trade impulsively, you're going to fault me. You're going to say you weren't around. When I posted that comment this morning, I spent the day with my wife. I haven't seen her for a week. And I'm not obligated to babysit anybody to a community post. I don't even do that with my mentorship. They pay me. Okay, so again, it's all about responsibility. And I'm placing the logic in your hands. It's up to you to go through the charts, see if it fits you. If it doesn't fit you, folks, there's a lot of other ways to trade. There's lots of ways to trade. You don't need to trade my way. Okay, I'm biased. I believe mine's the best. I believe I can outperform anybody in any style of trading, and I can do it consistently. Will that translate to you? No. But I'm saying and promising that you're going to learn how to read price better than you ever imagined. It's worth the investigation. Look into it. See if it doesn't hold up. But don't do things outside the rules I'm giving you. And that's why I teach this way, slow, incremental pieces. Because invariably, you're going to do things impulsively if you lack self-control. If you don't have self-control, you're going to blow up. And folks, listen, there's nothing worse than thinking you understand something in a rush and then go out there and trade life funds and blow the account. It hurts. It's painful. It sucks. And it's easy to say, oh, it's that guy that wasn't there to tell me what's really going on. You know, if you had told me.
See what I'm saying? My psychology is decent because I used to be that person. And I was rightly so, which is interesting because there'll be so many false gurus, false traders, false people that focus more on selling courses than they do the actual strategy of things. They just sound good. They make sense. They hindsight trade, all these different things. But guess what? When I would use their model or use their strategy and it would work, I'll be happy. But when it doesn't work, I'll get upset. I feel like the markets is against me. I used to blame the markets until I read a book called Trading in the Zone and it talked about the psychology behind trading. And it taught me about those things. They said, are you saying this? You know, those advertisements that say, oh, are you single? Or do you need to sell a house? Or have you recently had a fall or something in workplace and you need some, and they're trying to sue you or something like this? Or they say, what's one of those popular ones? What do they say? They say things like, have you experienced discrimination in your workplace? Have you paid so many taxes and think you are entitled to a tax return? Call us. Or things like this, right? And when they say things like that, it hits you more because you can relate exactly to it. Why? Because you thought those exact words or you've experienced those exact things. And you want to see something cool? And literally 2 seconds, this should turn to, yep, aura. Anyway, yeah, so that's very important. Why? Because when you say those words, it triggers you to remember, oh, that's me. That's why when you're advertising or you're saying something, you need to talk to the people that are thinking the things they are thinking. And you know they're thinking the things because you thought them. And that's the key. I just dropped the key for myself there. Thank you, Holy Spirit. Because now I'm going to use that for when I want to actually do my videos. I'm going to word it in a way where I've thought those things. Thank you. I need to create. Okay, bet. So when I was learning from false gurus or false mentors, right? I call them false because they don't know what they're doing. And I would get angry at losing in the markets because I follow their model, right? And they simplify it so much that I don't even need to be a genius to work out what they said is, okay, this is that, or this is the model, or this is how it works. And I hear it and I'm like, yeah, you know what? That makes sense. It's so simple and easy. So I don't think I could now blame the strategy because I was doing the strategy is my point. So I was doing what they were saying. I was obeying their instructions. And when I would now not see success, I'll blame the person. Now, in that moment, in that environment, in that context of things, I was right to do so because I didn't know at the time they were false mentors. I didn't know. I didn't know better. So I was submitting to processes or people that I thought were better than me. In reality, I was better than them. So it's like a lack of order. Anyway, now the key is to get rid of. That's why it's key right now to obviously with the detail that we're going into to choose the right mentor. Because now if I submit myself to this thing that's taking me months to learn, weeks, days, hours, sleepless nights, I'm sleeping on some of the times I'm studying because I've had a long day, but I make sure I study every day. And I put myself through all this process for something that doesn't make sense or doesn't work. I have every right to say, what are you doing? Right? But I believe this system works because I've seen it before I even found the model. I've seen some of the things he's talking about beforehand. So when he was saying some things, it made sense. And I was looking at TJR, who's another trader, and he had a boot camp on his playlist. I was contemplating going through what he was talking about, and I opted against him. I haven't done full research into his strategy, like from start to finish. But when I was thinking about who should I follow, and I was looking at multiple sets of people, I found ICT, and his words met me more. TJR was more emotionally, he met me in the sense that he had a similar upcoming to where he's got to, right? And he had some success. He also brought a guy called Timmy who's teaching how to trade from scratch. Those are the types of things that would help me, right? He was speaking to me emotionally, but the thing about ICT, he spoke to me as a person, like as my character, who I am. The emotional side of things, don't get me wrong, I'm a man, and even though I'm a man, I still have emotions. So there are going to be some things and some people that can appeal to my emotions and succeed. Very rarely, but it's possible. So I could have gone on this mentorship. I don't know if it would have been the right decision. But with ICT, first of all, he doesn't have a face cam. He doesn't care if you've listened to him or not. He is very transparent, honest, shows live trades, shows his live accounts to the degree he can show them in, of course. He then also talks about things that you would know. He talks about the grind, the hard work, the things you have to submit yourself to, the consistencies in his teachings. You know, and he tells you to find faults in what he's saying. That's how confident he is. And you can then go do your own research into what he's saying and see for yourself if it's true or not. It's kind of similar to the Bible, where the Bible is irrefutable to the point where you can go do your research, try disprove it, and you will fail if you have honestly tried to disprove it. Because there's a difference between trying to disprove it and then you're so biased to the point where you twist what the word is saying to suit your agenda. That's not what I'm talking about. That's dishonest disproving. But dishonest disproving is you, even if you have a bias, right? That's fine. That's not the problem. But you don't take that bias and input it into what you're reading. Because when you put that bias, you would read the bias. If I'm biased, let's say I'm a company, I'm biased to hiring Asian women that are above 6 foot. What do you think is going to happen when an Asian woman below 6 foot appears, or a white person appears, a black person appears? What do you think is going to happen? I'm probably not going to hire them. I may hire one or two, but there's going to be a pattern. And you're going to see the fruits of my bias. And what's that point? That company, if somebody's coming in, they're going to try, I don't know, they're trying to see if it's discrimination in the hiring process, and they see a pattern in the type of people I'm hiring. My bias is present. So I'm not really trying to find the best workforce. I'm not trying to find the best company. You will see the bias. So the same way, in a way, if you're trying to disprove something or read the Bible, go through his mentorship, and you have a bias against it, there's not a problem having a bias, but it shouldn't affect the decision-making process. It's okay to have a bias, but it shouldn't affect who you hire. It's okay to have a bias, but it shouldn't affect the truth. You shouldn't twist things to fit your bias. That's my point. Maybe I didn't use the best analogy, but it's off the dome, so...
This or that, I wouldn't have lost money. No.
For plans, coming up to 2 hours on stream, we're gonna finish this episode, which should be done in the next 10 minutes. Then we'll show you the changes on the website, and then we will end stream. And I will relax, eat, sort myself out, and then get ready for church to come back, do more studying, prepare for Sunday, go to Sunday, church, come back. Is there football on Sunday? I haven't really been watching football as much because we have daily prayers in the evening every day. So tomorrow, City play, right? Oh, they play Monday. Or was it Tuesday? I won't be able to watch that. May be able to watch this. I don't want to watch it though. Then let me see. Today or tomorrow. Okay, we can watch the United Liverpool game and the Villa Tottenham game. I may be able to catch this. I don't mind watching these. And then what's Spain saying? Madrid may be. I have to look at the table. I only want to watch like important games, like the Villa Forest game. Villa are pretty much clear anyway. If they have like a space, but it's Chelsea I want to see more. So, wow, they haven't scored in 5 games and they lost every single. Wow, they were here 5 games ago. That's crazy. They have the same form. Even Burnley's been doing bad. They've been scoring. That's terrible. Right. They've been the worst. 0-11. Anyway, let's finish this episode off.
No, because I'm never putting any of my students in a position where they have to be handheld through a trade. They're putting themselves in that if they did it all, and they get themselves out of it. That teaches responsibility, and you have to own those results. Good or bad, they're yours. And that's why I tell everybody, when they find success in this, and they like to say, hey, it was all credit to you, ICT, without you, I could have done this. Wrong. The only thing I did was show you how to read price. I did not sit with you and push a button. So if you took on that risk, if you sat through learning and worked through all the back testing and studying and forward testing, demoing, and producing a track record that you can feel confident in, then and only then, with the time that you choose, not when I say so, because I never tell anybody to trade life funds. In fact, right now I'm reminding you, don't trade life funds. When you make that decision, should you ever do so, you've done it on your own accord. So if you make money, whose success really is that? It's yours, and it's well deserved. Never, ever champion me for your success. Now you can thank me for helping you with the logic, but I didn't help you make money. And just as well, I did not help you lose it either. Those buttons getting pushed, you pushed them, and you have to sleep with yourself.
Kind of like when you really listen to what he's saying, how can you really argue with a lot of his points? Because it's true. I mean, at the end of the day, when I'm successful and if it's because of this model I would say the things he said we shouldn't say because I'm very logical. If your intervention wasn't present, I would have been stuck in bad models, bad mentorship, bad ways of thinking. And if you're the reason why I'm not there and I'm in a good place, making money, success, X, Y, Z, and I'm not silly to not notice where that success came from.
Knowing that that's the results that you provided, and there it is. You live with it. And if it's a bad taste in your mouth.
But at the end of the day, he is right though. Any person pressing the button, it's. I know people say, I made you, I made this. And there's some element of truth in that. But at the end of the day, it's like a singer, right? Let's see, I think people use Beyonce a lot as an example. Like she still has a singing coach. And the singing coach may say, you know what, I made you. Maybe when she was growing up, there was a person that made her sing or forced her to sing or taught her how to sing and whatnot. And yeah, that skill is probably caused by them, but it's still Beyonce that has to go pick up the microphone, right? So there's going to be an element of, yes, you helped. And yes, if Beyonce was a good person, she would sew back into the things that made her who she is. Well, it doesn't make a good person, but that's one of the things a good person would do. At the end of the day, though, it's not those people that taught her that are holding a microphone with millions of followers that has the brand that she has, that does the things that she does. It's her. So the same way each trader, myself included, when we see success, as we see success, yes, some people have helped us along the way. At the end of the day, they are not here in my room forcing me to press the button, like you said. So I understand this.
Well, it's the way it is. It's bitter medicine, but it's good for you. You'll learn from it. Or it'll take you out of business. That might be the best thing for you. If you can't stick to the rules, this game has a funny way of taking you right out of it.
Yep.
But people that are consistently profitable, it's not by luck. And they're not stupid. They have a logic they adhere to. They have rules that they trade with, and you have to stick to them. When they deviate from them or do something outside of what that rule-based strategy is, then it's reasonable to expect ruin or loss. And those moments are most painful because you look back and say, this is not what I should have done. That's why I shared that other guy, Ford. I'm sure he has a strategy.
Okay,
but for that reason, from his commentary, he suggested that he just lost control of himself.
What's so interesting that we've literally just been learning about this in church prayers. We have 100-day prayers, and it was during yesterday, basically this past week, and we're talking about instruction. How instruction is one of the most powerful tools that God has for us. And my pastor was saying how He loves rules and regulations because it allows him to. It's very clear the lifestyle he can live because there's definitions of what he should and shouldn't do. One of the things he did when he entered into a marriage, being that he never done it before, it was an area of his life he was new to. He sought instruction. He looked for instruction. And that's key because it allowed him to, once he got it, he said he found like one or two people, it allowed him to now walk in a direction that's clear. And the same is for us traders that this is why I love trading, not because it's fun, it's work. You think I enjoy watching somebody else talk for hours, explaining all these nuances and these different, it's a candlestick for goodness sake. And I'm out here watching it every single day. I've seen this screen thousands of times over the course of 13 years of my life, more years of my life. I'm 23. I've spent more of my life looking at this than I have not looking at this. I do not enjoy it all the time, right? Don't get me wrong. I say it all the time. Let me not lie and say I don't enjoy it at all, right? But the main thing about it I enjoy is the results you see are based on the work you put in. The results you see are directly reflecting what you've done. I think that's what makes it worthwhile, what makes it interesting, what makes it fun. That's the limit. That's the bracket.
So doing things that make no sense. Anybody that's ever traded with live funds knows exactly what that means. If anybody has ever traded live funds, they understand what that man was saying. I know, I've done a lot of 90s. I know exactly what he's talking about. But it feels like it's never going to work, and you just want to beat yourself up. You're going to have losing trades, folks, okay? In your journal right now today, with today's date, make a promise to yourself right now. I promise that as long as I'm doing this, I'm going to endure losses. Notice I said endure. You're not going to be defeated by those losses. You're just going to have to endure them. Because trading is all about managing losing trades. You got to trade your way out of losing trade every single time you get in the market. Every single trade. So you start off, you're under the commission, you're under the spread in forex. You got to know that. Every trader is a losing trader that finds success out of loss or suffers ruin in it.
Wait, say again. I think that was bars. Hold on. I promise I will endure losses.
Trader that finds success out of loss or suffers ruin in it. That's it. It's not.
Let me get a day and time. So 2nd of May, 1409. My name.
Every single trade. So you start off, you're under the commission, you're under the spread in forex. You got to know that. Every trader is a losing trader that finds success out of loss.
Every trader is a trader who finds success through or after loss? Through loss. Let me hear that one more time.
Managing losing trades. You got to trade your way out of losing trade every single time you get in the market. Every single trade. So you start off, you're under the commission, you're under the spread in forex. You got to know that. Every trader is a losing trader that finds success out of loss or suffers ruin in it. That's it. That's the only two things that can happen. All right, so now let's talk a little bit about the model and give you a little more details. And if I feel like I beat up and doing this, depressing because I'm not
Like
here. I promise it was good stuff for you. Okay. Now I want to talk about where do these setups form. So in your journal, this is like a subtitle area for this video. Where do setups form? Okay, think about that for a minute. When you're looking for this idea that I'm sharing, where would you expect them to appear in price? Obviously, I'm teaching you to run below high or relative equal highs. And if you're bearish, that would set up a scenario where the market goes up, sweeps the highs, breaks back down below the highs, short-term lows taking out this place.
So that's exactly what we were talking about earlier. He was finding out or teaching us where. We use this example. This is where. This is how. We're going to talk through where. So where is important. There's a difference between where the price is going, but where setups form. I literally said the exact same thing. I haven't heard this like this before.
And then you go back through that displacement leg looking for if the short into. That's pretty simple logic, isn't it? Well, visually, I want you to understand it. Okay, so that way, in your mind, I do this exercise all the time with my students. Can you draw out with a diagram, like if you were at work and you're trying to explain to your friend or coworker what it is you're looking for in price? Now, they're not going to understand what you're doing, but how would you draw it out in price? Or in a napkin with a pen and pencil, what would it look like? Well, you have obviously a level of roughly equal highs, and we're going to use that green line as an example of that.
Let me try to draw it. So, relative equal highs right here. We then have, okay, we can make it like this. Oopsie. Then, how should I draw this? I should draw arrows. We have price sweeps. This is for sales. Sweeps these equal highs that are somewhere over here. All right, so we sweep it. Then we have, oh, hold on. What was I using before? Okay. Well, that's equal highs. Oh, yeah. We have a sweep of the equal highs. Then we have a marker to the shift, retracement, and then we enter sales towards, you guessed it, somewhere else. Now, our target isn't always going to be equal highs, equal lows, sorry. It could also be fair value gaps or imbalance. So I'm just going to put liquidity and imbalance. Those are our two targets. And then we can continue this. And then we enter that retracement into the fair value gap. And our target, or we can make it neutral like gray. And then we have another target. It's gray as well. And then our target, nope. So we enter gray, the move, and we take a profits here. We then have a value gap. Fair value gap here. In theory, we actually enter on low hanging fruit. So let's see, this is my personal chart. Let's see what he got. So a sweep of the highs, displacement, breaking market structures to the low right here. A retracement back into the fair value gap. We enter, we then trade it to the next liquidity or imbalance. This is up to us. This could be a long-term target or this could be a low-hanging fruit. It's just perspective.
And price is moving towards it. Small little correction or so. And it runs towards it again. And then finally it runs through the relative equal highs. Okay. At that moment, as soon as it goes above it, you start panning back through all this price running here and find the nearest short-term low. Because that right there is going to be your trigger. It's not that it goes above this old relative equal high and it goes down below that. That's not it, folks. That's not it. You have to see it go below that and displacement with an energetic move, take out a short-term low. That's how you filter out these trades that may not be high probability. So that area right there, as soon as you run above the relative equal highs, in your mind, you're looking for where's the trigger. Because until it takes out that short-term low, there's nothing going on. There's no trade there. There's no setup there. Then when there's displacement, that displacement leg in price action, that right there is your foundation to the setup. That's it. Once you have that, then you can go into that area and look for the fair value gap. That's the logic. That's the pattern. That's what you're looking for. This is if it's bearish. Now, if those relative equal highs have been traded through this morning, I would expect this scenario. Okay. Before it ran those relative equal highs, I was looking for, like down here, price was trading down into that area. I was showing my interest in it. I'm watching this, where it was likely to go down to, this is kind of like the low. In my mind, I'm kind of using it as an example. What I was expecting price to do once it got down into that fair value gap. I was saying, I'm watching this little arrow, got that little gap. I was expecting this type of movement to set up the run above those relative equal highs, but there was no movement here to set up that run either. So, two scenarios that I would have loved to see develop just did not pan out. It just simply wasn't there. Now, I'm going to teach you another approach. This is kind of like what I was expecting. And had it panned out this morning, if it would have gave the real setup, which it did not, I've already shown that. That little fair value gap that I was waiting to see a response in, it didn't do it. It just melted right through it. But if it would have done, that's what you're looking for. This is it.
Yeah, we pretty much got it. I didn't know, obviously, what he was going to do, so I did probably a bit much. Well, that's more too much, but just crop it. This to this and this to this.
If it's bearish. Now, if those relative equal highs have been traded through this morning, I would expect this scenario. Okay. before it ran those relative equal highs, I was looking for, like down here, price was trading down into paying out. It just simply wasn't there. If you have an old fair value gap above you, okay, so you have an old fair value gap and the market's below it and it's trading up, and you're bearish, but you think it's going to go up to that fair value gap. The same logic when it trades up to the relative equal highs. Once it trades into that fair value gap, it doesn't have to completely close it. If it trades up into it, anywhere between here and here is good. Okay, if it trades above it, you can really make it simple and say, okay, the low of the fair value gap, treat that like the same logic that you use for the relative equal highs. Doesn't that make it simple and easy? That way you don't have to worry about how hard do I need to know? You don't need to know that because you're waiting for something to happen. What is that? Once it takes out the low of the fair value gap and trades in there, you go back through that leg and see, okay, here's what? There's that trigger.
That's another thing we didn't do. So if it trades into here, it's almost similar. If I wanted to just enter this, we don't just enter on a touch. But then wait, I've seen it happen before. Oh no, wait. I'm mixing up entry and aware. Hold on. Let me try. I'm gonna close my eyes. I'm not thinking. In those instances, we've had the prerequisite to then enter. As such, the prerequisite I was taking from all the way. Wait. Over here. Swept the lows. When you have like any displacement taking out this high, we had the taking of the high over here. We have displacement. We have displacement from here to here. It trades into it. It pushes up. That's the prerequisite. So when we get things like this, if it would have been worked out over here. Oh, that's another question. I have so many questions.
That's that shift in market structure you're waiting for. Then you have the displacement leg. So once you have that, you can go back in and look for the fair value gap. Okay, so that's the two entry strategies for this model. There's no other way of worrying about what does it look like this now.
Okay, so you mean basically what I'm done is where setups form. This is just us. I'll be able to match vibes.
Visually, this is what you're doing.
Okay? So let's say these equal highs are on the hourly, whatever. They sweep, bam, bam. Or this is fair value. We pull up into fair value. We have the market to shift. We then look for re-entry. So I think that was my confusion, is that you're looking for a fair value gap within a fair value gap. So here we have the fair value gap and we break, but we now need for price to come back into the fair value gap, right? So if it's just this time frame was trading, we'd then be looking, so okay, we have this fair value gap, we swept, sure, we came up, but guess what? I'm expecting price to come back into this fair value gap, and that's when we get our entry, because it's within that range of the initial move from the fair value gap. So we had the fair value gap that broke this, which confirmed, okay, we want to go up, we come back down to it, we just didn't come back. And if we, into this, we would have just taken a normal loss. But that's the point right there.
Okay, it's simple. And if it feels like it's not simple, watch this part of the video a couple times and then go back and look at price action in live data and in old backtesting. Go back and look at old moves and you'll see this logic is there. Okay, it's algorithmic, it repeats. Unfortunately, today, it didn't give me the setup to allow myself to sit down to you and say, okay, this is what I did because I was going to trade it. Okay, I was going to enter at the low, run the highs, go short, and write it down that way too. I was going to do it.
Wait.
But nothing came down. It didn't mean that the model's broke. It doesn't mean that the model's broke. It doesn't mean that I can't find winning trades. It just means that the market did not provide the structure to allow this to form. Does it result in a losing trade? No, because the logic wasn't utilized that would put me on a losing trade. It never formed. This right here, reverse the logic here. Apply it. That's the homework. Apply this logic here. Does this appear in the fair value gap that I was drawing your attention to this morning on the post? No. And no one can manipulate it and say it was. It just wasn't there, folks. So it's just a missed move. And there's nothing you can do about it except for beat yourself up and say, oh, I wish I would have, should have. And that stuff doesn't make you money. And it doesn't take any more money out of your pocket. So don't do it. Don't waste time doing it. It's toxic thinking. So that I don't need to bring up all this negativity anymore and address any of it like this because I'm never going to entertain it in a video again. But I want to lay the foundation and provide my response to anybody that would think like this or say this, whether they're trolling, whether they are sincere, whether they feel like they've been victimized. Okay, you've done that to yourself. If you push the button and you trade, you did that. Nobody in this community, including me, chief of all of them, never told you to buy or sell anything. You're never going to have instructions where I'm telling you to buy or sell anything. It's always going to be study this, observe this, watch this. That's what I'm saying. They're not code words for anything. They're specific elements of study. Put your attention here. Watch and see. Observe. Is there any characteristics repeating with the logic that I teach? That's not trading. Okay, that's not trading advice. That's not investing advice. That's not money management advice. It's just practicing reading price action, and that's how I teach. It might not be for you. Maybe you want me to drive around in Lamborghinis and lie to you about stupid stuff that ain't gonna work in the market. That's just not what I'm gonna do. That's not me. I do things in the charts that make sense. I teach it. It's transferable knowledge. But you have to be prepared to receive it, study it, practice it, and endure all these times where you look for something to be there and it doesn't happen, and then a move takes place that you've missed. That's the test. Are you gonna lose your mind because you missed a big move like today? I used to do that when I was younger, and it got me nowhere but backwards. Don't live in your losses. Missing moves is a loss. Taking a monetary loss in the market is a loss. Taking a demo trade that's a losing trade, that's a loss. the mental impact on that, you have control over. You can decide to amplify every bit of that, or you can say, you know what can I take from this so that way I can never be hurt this much again by it, because it will repeat. But you have to be able to condition yourself so that way when these knocks and trips and falls and setbacks, when they occur, oh, I've been here before, that way it doesn't completely derail you. That's an important lesson. And unfortunately, no one really touches that because they all pretend that they never make mistakes and they always catch the runs. And I'm just not that kind of guy. I'm honest, I'm going to tell you. And if it doesn't fit you, again, change the channel. Until next time, be safe.
I think it's going to be a nice place to end here. We could probably spend another hour streaming, but the fact that I still have other things to do, I don't want to end up being, what's the word, when you're like finished. Cool. So in the meantime, we learned a lot. That helped us as well with finding out whether or not or why we lost the trade we took. But just to go through some things on the journal. So obviously we've put some more emojis. Every single one, they will have something that's relevant. You can, what else? Oh yeah, we changed the location of this because it was over here and then here. That was too minute. I wanted it to be a lot clearer, so I put it here. So you can edit your rules over here. And of course, it'll be here for you to see. That needs to go. Yeah, you still have these quick trades or quick filters. Let me see if this works. So the problem was, if I click off of it and go back, yeah, it's still there. So I need to, that'll be the next fix. I also want to change this to dashboard. What else? Calendar is working. We'll get more charts. It's not my priority right now. Yeah, agent is there. Account storage is there. Contact is there. Study journal. So this is what's new and I'm excited about. It's not fully complete, but I've been a while without an update. So I decided, you know what, we're going to do this anyway. So it's shaped literally like a journal. That's kind of what I was going for. And you have the options to do a live review, back test, etc. It's basically the same thing, but the only difference is literally kind of the questions it's asking you, etc., etc., etc. Okay, you also have pages up here. So let's create a back test, right? We have the image we can drop or add, sorry, drop or copy or paste. Let's say it's here. It's the old trait. We can now edit it, which is key. So you can draw circles. You can draw 1, 2, and guess what? You can describe each single circle you put. You can also draw this. You can even say it's a Fifth Valley gap. The only thing I need to do is make this section bigger. You can change the color. You can, there's so much you can do, and it's all labeled and annotated. So you can annotate now your pictures, right? Then you obviously check the instrument, and there's no drop down menu because it's up to you. You tell the date and time. The main thing is time. It's the most important. Not date and time, sorry, just the date. The time of things done automatically. Okay, I need to put that time. Time frame, you get 1 minute. The session, the direction, the bias, the outcome. What you saw, I saw this. Entry reason because of this. You can just put NA. So we won money. I learned about entry. Okay. This page will be all the blocks for Fifth Valley gaps. Whatever. Save. So then it looks like this. Then you can create a new page, and of course it could be something like live review. Live review. I'm gonna put random stuff just because I'm gonna show you. Okay, and then what do you have? We can filter through the journal now. And it gives you stats, etc., etc. And this is it in its most basic form. But it's gonna be super helpful because when I was watching this video, I had to go to, I'm using currently Google Slides. How much better would it have been if I had this journal here. So every time I could go through this, it has a screenshot. We can click on the screenshot, we can see it. And there's different things, obviously, like we have talks of what the annotations are. So it's more like a interactive journal. You know, it's the best thing that you can do. It's like I want it on paper and pen, but on a computer. That's basically it. And it's also compatible, easy to read, and it's also in one place. So I have my actual journal here still. So I can learn on one side and I can execute on another. And I have analytics. And then I'm going to upgrade the stats page eventually where it gives you analytics for different models. And then you can filter this. And it's a journal. So then you have chapters, you have all this. You can filter, but there's so much we want to do with this. It's a lot of work though. So that's why it's very much in basic form. That's what I wanted to show you. I did say it's coming soon, and it's now been a couple of weeks now. So just like, I'm going to put it out at whatever level it's at. And of course, the main thing still works. And we've got a couple more features on the main page. So that's all in the link in the description. That's the website we are currently upgrading daily, weekly. And we're also building other projects in the background. Now, it's a new month, and I did just come up with an idea literally today of what I could be building. I don't want to do this, but I think we kind of have somewhat of experience doing it. So it is also an idea I had when I was a kid, funnily enough. And I was actually taught to do it when I was younger. And now could be the time. So with that being said, I will probably start on that tonight / tomorrow / next week, Monday. One of the 3 days. And yeah, we'll get started on that and building on the side. So we now have 3 businesses we're going to be working on. And I still haven't launched the one I've been working on since April. Technically, I started early on March. But April is the kind of time frame I gave for it. How close are we to finishing? Now, we have some framework, but we are probably 25% done. Maybe 50. Hold, let me actually think about this. No, we're actually nearly done. We're nearly done. It's just like, to my standards, like we're like 40% done. If I didn't have any standards, we're like 60% done. We are over halfway, just tweakings and all that I'm accounting for. So yeah. So very productive session today. Either tonight, most likely not tonight because Sunday tomorrow. Most likely maybe tomorrow evening we'll start, and there'll be live markets, so we can actually be looking at some opportunities tomorrow as well. But that's been it from me. Hope you guys enjoyed, learned something today, and then we'll go again tomorrow. It's been your boy CJ, and peace.